Hello, my dear students. Greetings of the day. I'm back with another video, and in this video, I'm going to revise the next two important chapters, which are going to be number one, Introduction to the Auditing, and number two, Nature, Objective, and Scope of Audit. So, these two are basic concepts or basic chapters which sets the base for whatever auditing discussion which we will have in the rest of the chapters. So now in this video, I will dedicate the time for doing a quick and comprehensive revision of two chapters. What are those two chapters? Introduction to the Auditing and Nature, Objective and Scope of Audit. So without any delay further, let us try to start the discussion first with Introduction to the Auditing. See, Introduction to the Auditing is nothing but such a chapter which contains entire fundamental concepts relating to the audit. So this chapter gives us with enough of knowledge which we require in order to understand all the rest of the chapters. So those all fundamental things we have given it under one particular chapter named Introduction to the Auditing, which is going to contain all the fundamental aspects relating to the audit. So first we will start with what is the definition of audit, how the term the audit has been defined. So before we can understand the concepts relating to the audit, it is very much necessary on us for us to understand what exactly is the meaning of the term audit. The term audit has been technically defined in the standards, and the term audit is defined something like this. So if we go through the definition of audit, it has been defined as an audit is an independent examination of financial information of an entity, whether or not profit oriented, irrespective of its size or legal form, when such an examination is conducted with a view to expressing an opinion thereon. So how the term audit has been defined? It is an independent examination of financial information of any entity, whether or not profit oriented, irrespective of its size or legal form, when such an examination is conducted with a view to express an opinion thereon. So in order for this definition to be very much clear, first we should identify what are the key terms in the definition. So the key terms in the definition are number one, independent examination, number two, financial information, number three, profit orientation, number four, size or legal form, and number five, finally, to express an opinion on the financial statements. So first they are saying that audit is an independent examination. So what basically happens in the audit is examination is going to happen. So now what do you mean by examination? So examination means not the examination which you write. Examination, the general meaning of the term is verification, or even we can call it as checking, or even you can call it as scrutinizing. So whatever it is, we can call it by various other names. So what audit basically involves is examination. We do some verification there, we do some checking there, we scrutinize something there. And that examination process is not an ordinary examination process. That examination process is an independent examination. What kind of examination we do? So basically examination means verification, checking, scrutinizing. And that examination is not an ordinary examination which we do in the audit. It is an independent examination. Now what is independent examination? Independent means free from influence. What do you mean by the term independence? Free from influence. Which means, for example, if I am able to take the decisions without getting influenced by others, if I am taking decisions without giving importance to other person's wishes and directions, if something is correct, without any second thought, I am saying that as correct. If I feel something is wrong, without any second thought, I am definitely saying that as wrong. So whenever I am saying something, I am not under anybody's influence, I am not showing any kind of bias, I am not showing any kind of partiality. Such an ability of a person to take a decision without coming under anybody's influence, without showing bias, without showing partiality, that characteristic, that nature of an individual, we call it as what? Independent. So audit basically is examination, and that examination process will be carried out independently. Without any influence, that process will be carried out. Okay, so we understood audit is an independent examination, but what are the things which we are going to examine? You told audit is an independent examination. Agreed. In audit, when I say I'm doing audit, I'm verifying, I'm checking, I'm scrutinizing, and that process of checking or examination, I have to do it independently. But what is the thing we have to examine, sir? That is addressed by the next part of the definition, in which they say that an audit is independent examination of financial information of an entity. What is the thing which is getting independently examined here? Financial information. So now what is financial information? So let me put it in simple terms. The term financial information means it is a combination of the financial statements and the underlying data which is used for the preparation of financial statements. What do you mean by financial information? Financial statements and the underlying data, the underlying source data, which is used for the preparation of financial statements, which we simply call it as books of accounts. So as we all know, books of accounts are the source for preparation of financial statements. So the combination of financial statements along with the books of accounts, that collective information, we call it as financial information. So when I say we are doing audit, we are doing independent examination, and the thing which we are doing the independent examination is financial information, and the financial information means nothing but financial statements and the books of accounts. Now, what is the definition of the term financial statements? There are so many definitions given to the term financial statements, but we will talk about the definition given to the term financial statements under Companies Act 2013. And the definition to the term financial statements in the Companies Act has been defined in an inclusive manner. The definition of financial statements under Companies Act 2013 is an inclusive definition. When I say inclusive definition, we can broadly divide definitions into two categories. One is exhaustive definition and the other one is inclusive definition. If I give you example of exhaustive definition, whatever definition of auditing we are able to see it here, this is an exhaustive definition in which they will exactly say this is what the term means. But there will be other kinds of definitions which will not exactly define the term, but instead they say what is included in that definition. At some places, some definitions will be of such a nature that they don't exactly say what is the term, but instead they say what is included in that term. That kind of definitions we call it as inclusive definition. And in fact, the term financial statements has been defined in an inclusive manner. So it starts something like this. They say, as per Companies Act 2013, financial statement includes the following. The financial statements include the following items. Which are they? Number one, it includes balance sheet. Number two, it includes statement of P&L. Number three, it includes the statement of cash flow, or simply in our common terminology, we call it as a cash flow statement. It includes statement of changes in equity. It includes even notes annexed to or forming part of financial statements. Notes which are annexed to financial statements. Annexed means attached to the financial statements. If I have to put it in the knowledge which in the terminology which we are aware, nothing but notes to accounts. So financial statements as per Companies Act is an inclusive definition, and that contains 5 components. What are they? It includes a balance sheet. It includes a statement of P&L. It includes a statement of cash flow. It includes a statements of changes in equity. It includes notes to accounts. Now, what information will be shown by balance sheet? As we all know, it shows the financial position of the company as on particular date, and that date will be balance sheet date, which is generally 31st of March in our country. And statement of P&L, this statement will actually show the financial performance, whether the company has made a profits or losses during the year. Statement of cash flow, this statement shows whether the company has made total cash inflows or total cash outflows, and that inflows or outflows divided under 3 categories: cash flows from operating activities, cash flow from investing activities, and cash flow from financing activities. Similarly, the statement of changes in equity is a statement which shows the net increase or decrease in equity happened during the year. And when I say equity here, equity generally means share capital along with the reserves and surpluses. That cumulative balance, we call it as equity. And if I prepare a statement which will tell me the reasons for difference between opening and closing balance of equity. So if the opening equity balance is 100, if the closing equity balance is 120, I will try to prepare a statement which will explain me because of what reasons this increase of 20 crores happened during the year. That statement, we call it as statement of changes in equity. And apart from that, if we have a look at the financial statements of the companies, they will even contain notes to accounts also. Notes to accounts is also integral part of the financial statements. Notes to accounts is also an very integral part of the financial statements. So all these 5 items put together, they make financial statements. This is what the definition given to the term financial statements under Companies Act. And even books of accounts has also been defined. This definition is also an inclusive definition. They define books of accounts as something like this. It includes records maintained in respect of money spent and received by the company. It includes records which are maintained in respect of money received and spent by the company and the matters regarding which that receipts and expenditure takes place. Nothing but simply cash book. Like if I show you the definition here. So books of accounts is defined under section 2 subsection 13, and it is also an inclusive definition. Why? Because the definition is starting with the term includes. So it includes records maintained in respect of all sums of money received and expended by the company. Whatever records that you are maintaining to record the money received and expended and the matters regarding which you are spending or receiving this money. Nothing but, in simple terms, if I have to put it, cash book. So cash book is actually the record in which we will try to write down what is the money received, what is the money spent, for what matter we have received it, for what matter we have spent it. And even books of accounts includes records which are maintained for recording the details relating to sales and purchases. Whatever records which an entity is maintaining for recording the details of sales and purchases, that books also will come under books of accounts. And records maintained in respect of assets and liabilities of the company. Whatever records which an entity is maintaining to note down the details of assets and liabilities, that also will come under books of accounts. And then finally, the items of cost as may be prescribed under section 148 in the case of a company which belongs to any class of companies specified under that particular section, which is section 148. Nothing but cost records. But the thing which we need to keep in mind here is cost records will not form part of books of accounts of every company. Because cost records are not mandatorily applicable for all companies, there is a section 148 of the Companies Act which will set out the criteria which if the companies fulfill, cost records will become applicable for them. Only those companies for which section 148 is applicable, for those companies only cost records will form part of books of accounts. If there is a certain company which is not fulfilling the criteria required as per section 148, then they will not be required to maintain cost records. Then the cost records will not form part of their books of accounts. See, why I am stressing this much is sometimes they might pose you a true or false statement. Assume a true or false statement is tested. All companies must include in their books of accounts cost records. Assume a true or false statement is tested. All companies are mandatorily required to include cost records in their books of accounts. Is this given statement true or false? This statement is false. Why? Because cost records will not form part of books of accounts of every company. Cost records will form part of books of accounts of only those companies which are actually covered under section 148. Clear? So now this collective information, financial statements along with the books of accounts, this collective information, we call it as financial information. And if I am doing audit, what I'm actually trying to do in the audit is I'm trying to independently examine, independently verify, independently check. And what I am checking? Financial information I am checking. And what is meaning of financial information? Financial statements and books of accounts of the company. If I say I am conducting audit of Reliance Industries Limited, what I will do there? I will independently examine financial statements, books of accounts of Reliance Industries Limited. If I say I am conducting audit of so and so company X Limited, which means what I am doing there? I am independently examining financial information, that is financial statements and the books of accounts of X Limited company. Understood? So this is what actually happens in the audit. So audit is an independent examination of financial information of an entity. Now let us come to the next part of the definition, in which they are trying to say here whether profit oriented or not. What is the next part of the definition? Whether profit oriented or not, which means that the entity for whom you are doing the audit, whether that entity is a profit making entity or that entity is a non-profit making entity, that doesn't have any impact on the audit. Whether you are conducting audit of a profit making entity, whether you are making audit of a non-profit making entity, that doesn't have any effect on audit. Audit as a scope is not going to change. If I am conducting audit of a profit making company, Reliance Industries Limited, what I will do? Independently examine their financial information. Sometimes I might be asked to do the audit of non-profit making entities. If I give you examples of non-profit making entities, some trust like old age home, orphanages, etc., places of religious worship like temples, churches, mosques, etc. So even if somebody is asking me to do the audit of this non-profit making entities, there also I will independently examine financial information. I will not do something else if I am doing audit of non-profit making entities, which I will not do in the case of profit making entities. No, there will not be any change. If I am doing audit of a profit making entity, I will independently examine financial information. If I am doing audit of a non-profit making entity, there also I will independently examine financial information of that entity. So my client's profit orientation, whether my client is a profit making entity or non-profit making entity, that doesn't have any impact on audit. Next one, irrespective of its size or legal form, which means the size of your client and even the legal form of your client also doesn't matter in the audit. Even size of your client, even legal form of your client also doesn't matter, irrespective of the size. Which means I might be doing audit of India's biggest company, Reliance Industries Limited. What I will do there? Independently examine financial information of Reliance Industries Limited. I am conducting audit of one small company in my locality which is hardly having a turnover of 1 crore rupees. I am conducting audit of a small company in my locality, in my close proximity to the office. For example, in this building, my office is there. In the close building, another company is there. Small company, hardly 1 crore of turnover. That company asked me to do the audit. What I will do there? Independently examine financial information. So whatever I do in that Reliance Industries Limited, the same things I will do it in the audit of this small company also. Just volume of my work will be high. Volume of the transactions which I will be verifying high. The volume of the books of accounts and financial statements will be high. The time which I spend will be high. That's it. Scope is not going to change. Scope remains the same in both the cases. In Reliance Industries Limited also my scope remains the same. In this small entity which is hardly having turnover of 1 crore also my scope remains the same, which is nothing but independent examination of financial information. I will not do something else in Reliance Industries Limited which I don't do in the small company which is having a turnover of 1 crore. Just volume is bigger, time which I am spending will be higher. That's it. The scope altogether is not going to change. And even they say irrespective of legal form, even legal form of your client also doesn't matter. What they're saying, irrespective of legal form, even legal form of your client also doesn't matter. Sir, now what do you mean by legal form, sir? Legal form means simply the legal constitution which you are giving to your entity. How your entity is legally recognized. Like if I want to start my business, I can start it as a sole proprietorship firm. If I want to join my friends in the business, I can create a partnership firm. If I want to do the business along with my family members, I can create a HUF. I want to carry out the business in an organized manner, I can create a company. So if I want to carry out some activity for non-profitable activities, I can create a society, I can create a trust. So nothing but very much similar to SSC, the person definition under Income Tax Act. So legal form means how your entity is legally recognized. Is your entity recognized as a partnership firm? Is your entity recognized as a sole trader? Is your entity recognized as a LLP? Is your entity recognized as a company? So that legal structure which you are giving to the entity, we call it as legal form. Now they are saying irrespective of legal form. What is the meaning of irrespective of legal form? What is the significance of irrespective of legal form? The significance of the term irrespective of legal form is even the legal form of your client also doesn't matter. Even the legal form of your client also does not matter. If you are conducting audit of a partnership firm, what you will do to that partnership firm? Independently examine the books of accounts and financial statements. If you are conducting audit of a company, what you will do there? Independently examine the financial statements of that company. If you are doing audit of a sole proprietor, what you will do there? Independently examine the financial statements of that sole proprietor. If I am conducting audit of a trust, what I will do? Independently examine the financial information of that trust. So size or legal form also doesn't matter in an audit. So now I hope everybody is clear with the definition till here. So what exactly happens in an audit? An audit is an independent examination of financial information of an entity, whether or not profit oriented, irrespective of its size or legal form. But what is the ultimate objective of that examination? I am not doing that independent examination for time pass. I am not doing that because I am having some fun in that. No, if I am doing independent examination, there should be some ultimate outcome out of it. Every work should contain outcome, no. So without outcome, if you are doing some activity, what is the purpose of doing it? Even in the audit also, if you are saying you are independently examining financial information of the client, what is ultimate objective of doing it? That is expressed in the last part of the definition, which says with a view to expressing an opinion. What is the ultimate objective of the entire process of audit? The ultimate objective of entire process of audit is to express an opinion thereon. On what you will express opinion? Whatever you have verified, on that you will express the opinion. On what you will express the opinion? Whatever you have verified, on that you will express an opinion. What is the thing which you have verified? I have verified the financial statements and books of accounts. Then on what I will express the opinion? On the financial statements and books of accounts only I will express my opinion. Understood? So the ultimate objective of this doing entire independent examination of financial information is to express an opinion on financial information, express an opinion whether the financial statements and the books of accounts are correct, whether they are giving true and fair view, whether they are misleading or not. You have to express that opinion on that financial information, whatever you have verified. And finally, that opinion on the financial statements could be either a good opinion or a bad opinion. Any opinion you take in this world, that can be only divided into two categories. You can call it as either good opinion, bad opinion, or even you can say positive opinion, negative opinion. Like for example, if I gave you some food to taste and tell me your opinion, if that food is tasting good, you will give a good opinion. Yes, the food is tasting very good. On the other hand, if the food is tasting very bad, you will give a bad opinion. No, this food is tasting very bad. So similarly, the auditor's opinion, the opinion which we are expressing ultimately out of this audit on the financial information, that could be a good opinion, that could be a bad opinion. If I am convinced that is financial information, whatever I have verified is correct, is not misleading, is correctly prepared, then I will give a positive opinion, good opinion I will give, which in technical terminology we call it as unmodified opinion. On the other hand, if I am not satisfied with the true and fair view of the financial statements, if I find some mistake in the financial information which I have verified, I will give a bad opinion. I will say these financial statements are not giving true and fair view. Clear, everybody? So this is what the ultimate objective of the entire audit. Now everybody repeat the definition of audit along with me once for the last time. Audit is an independent examination of financial information of an entity, whether profit oriented or not, irrespective of its size or legal form, when such an examination is conducted with a view to express an opinion thereon. Understood? So as a part of this definition, we have covered various aspects. We understood what is independent examination, we revised what is financial information, and as a part of financial information, we revised the financial statements and books of accounts. We understood what is the size of the entity, what is the legal form of the entity, and what is the meaning of expression of an opinion. Clear? So now let us come to the next fundamental concept in this entire audit subject. So once we are done with this definition of audit, the next thing which we need to understand is what are objectives of audit. What are objectives of audit, or what are objectives of auditor also you can say. So now when I say objectives of audit or auditor, just now in the definition I have covered, the ultimate objective of the auditor is to express an opinion. That is the ultimate objective. And this opinion has to be expressed regarding two matters. This opinion has to be expressed regarding two matters. Number one, whether financial statements are free from material misstatements. Number two, whether financial statements are prepared as per applicable financial reporting framework. So the ultimate objective of the auditor is definitely to express an opinion, and that opinion has to be expressed regarding two matters: whether financial statements are free from material misstatements and whether financial statements are prepared as per applicable financial reporting framework. So we'll come back to the first point later. We'll come back to the first objective later. First, we will try to spend our time in understanding the second objective. What is that? Financial statements are prepared as per applicable financial reporting framework. Now we need to understand what is the meaning of this term applicable financial reporting framework. So let us try to divide this entire lengthy term, and we'll try to divide it into subparts, and we'll try to understand the significance and meaning of each of this part. Like first, I will start with framework. So what is the meaning of the term framework? Framework means, simply put, rules and regulations for doing some activity. What do you mean by framework? Framework simply means the rules and regulations for doing some activity. Like for example, if I have given you some rules and regulations for attending this class, that is a framework for attending the class. If you are about to write an exam, I gave you 10 instructions which you are supposed to follow, according to which you have to write the examination. That is a framework for attending the exam. So if I have given you some instructions which you are required to follow for attending an interview, that is a framework for attending an interview. So a set of rules and regulations, or even you can call them as instructions. So set of rules and regulations or instructions which are required to be followed for doing one particular task, that I call it as framework. Then what is the meaning of financial reporting? If you ask me simply, financial reporting is just an other name for accounting process. Financial reporting is just an other name for the accounting process. So financial reporting means the process of preparation and the presentation of financial statements, that we call it as financial reporting. So framework means set of rules and regulations. Financial reporting means the process of preparation and presentation of financial statements. Then finally, if you combine both the terms, financial reporting framework. Now what is the meaning of financial reporting framework? Financial reporting framework means the set of rules and regulations which are required to be followed in the process of preparation and presentation of financial statements, that we call it as financial reporting framework. That's all. Simple. Combine both the terms. Framework means set of rules and regulations. Financial reporting means the preparation and presentation of financial statements. If you combine both, financial reporting framework, which means what? The set of rules and regulations which are required to be followed in the process of preparation and the presentation of financial statements, that I call it as financial reporting framework, nothing else. The set of rules and regulations which are required to be followed in the process of preparation and presentation of financial statements. See, assume an entity wants to prepare the financial statements. A company wants to prepare the financial statements. Can the company prepare the financial statements as per their own wishes, as per their own thoughts, whatever they have? Or should they follow one specific set of rules and regulations? They have to follow a specific set of rules and regulations. Like if a company is preparing financial statements, they will follow Schedule 3 and accounting standards. Now, Schedule 3 and accounting standards is simply a financial reporting framework. The set of rules and regulations which an entity has to follow for the process of preparation and presentation of financial statements. Schedule 3 and accounting standards. Clear? So we understood financial reporting framework. But in the objective, they use some other term. They are saying applicable financial reporting framework. Now, what is this applicable financial reporting framework? First, before I explain this term applicable financial reporting framework, I want to ask one simple question. It is whose responsibility to prepare financial statements? Will the auditor prepare it, or management of the entity will prepare it? Auditor will never prepare it theoretically, not practically, but as per theory, if you observe, financial statements are always the preparation of financial statements preparation are always responsibility of management. It is always the responsibility of management to prepare the financial statements. Then what is auditor's responsibility? Auditor will verify whether management prepared the financial statements in a proper manner or not. So financial statements preparation is always the responsibility of management, whereas auditor's responsibility is to just verify whether the financial statements are prepared properly or not. So management, while preparing the financial statements, keeping in mind the nature of the organization and also keeping in mind the purpose of the financial statements, the management will adopt, very important term, who will adopt? The management will adopt which rules and regulations they have to follow, that framework which management has adopted, keeping in mind the nature and purpose of the organization, that we call it as applicable financial reporting framework. Financial reporting framework means a set of rules and regulations which are required to be followed in the preparation and presentation of financial statements. Now, the management of the organization, while preparing the financial statements, keeping in mind nature of organization and the purpose of financial statements, the management will decide which set of rules and regulations will be applicable for them, and they will adopt it. That rules and regulations which are adopted by the management. Very important, guys. Applicable financial reporting framework will be adopted by the management, not the auditor. Management, keeping in mind the nature of the organization, purpose of the financial statements, the management will decide which rules and regulations they have to follow. That rules and regulations which are adopted by the management, we call it as applicable financial reporting framework. Let me give you a few illustrations for the same. Assume the Reliance Industries Limited, the management of this company wants to prepare the financial statements. The management, while preparing the financial statements, keeping in mind the nature of the organization. What is the nature of the organization? Company. Since the nature of the organization is company, the management decided that, keeping in mind this nature of the organization, which is company, they decided we will follow Schedule 3 and accounting standards. Now, Schedule 3 and accounting standards, which is adopted by the management of Reliance Industries Limited, will become applicable financial reporting framework for Reliance Industries Limited. Now, SBI management, while preparing the financial statements of SBI, keeping in mind the nature of this company SBI, which is a bank, they have decided that they will follow Banking Regulation Act in the preparation of financial statements. Since this is adopted by the management of SBI, this becomes applicable financial reporting framework for SBI. Now, the management of LIC, while preparing the financial statements, keeping in mind the nature of the organization, which is an insurance company, they have decided that they will follow IRDA rules and regulations in the preparation of financial statements of LIC. Now, IRDA will become applicable financial reporting framework for LIC. So, like this, keeping in mind the nature of the organization and the purpose of the financial statements, the management of the organization will select which set of rules and regulations they have to follow. That set of rules and regulations, we call it as applicable financial reporting framework. So, like the definition which I have given here, if you observe here carefully, applicable financial reporting framework. So, here if you observe this line, in view of nature of entity and purpose of financial statements, the management of the entity will adopt applicable financial reporting framework. They might ask you a true or false statements here. Entire sentence will remain the same, but only one thing will change. Now they will replace the term management with auditor. They will give true or false statement, something like this. They will give the entire statement as it is, but they will replace only one term. The term management will be replaced by the auditor. Now tell me, will that statement will be true? No. Why? Because the management will select what is the applicable financial reporting framework, not the auditor. So you have to be very careful when you are reading the true or false statements. Never ever attempt the true or false statements unless reading it twice. So you have to read it minimum twice before you can start answering MCQs and true or false statements. Clear? So with this we are done with the first objectives, which is second objective, whether financial statements are prepared as per applicable financial reporting framework. Nothing but as an auditor, I need to express my opinion. Whatever financial statements which are prepared by the management, are they as per applicable financial reporting framework? If I am conducting audit of a company, I need to express opinion whether my client company prepared the financial statements as per Schedule 3 and accounting standards. If I am conducting audit of SBI, I need to express opinion whether my client's management prepared the financial statements on the basis of Banking Regulation Act. If I am conducting audit of LIC, I need to express opinion whether my client's management prepared the financial statements as per IRDA rules and regulations. Understood? So this is what the second objective which auditor needs to comment. Now, since we have understood what is applicable financial reporting framework, let us try to understand what are the various types of framework also. We will even try to understand what are various types of frameworks. So now first we will try to understand the various types of frameworks on the basis of purpose of financial statements. On the basis of purpose of financial statements are divided into two categories. One is general purpose financial statements and special purpose financial statements. The definitions given are very straightforward definitions. They have told that general purpose financial statements are those financial statements which are prepared as per general purpose framework. Whereas special purpose financial statements are those financial statements which are prepared as per special purpose framework. Simple definition, no? Quite obvious. So they are simply saying on the basis of purpose, financial statements are divided into two categories: general purpose financial statements and special purpose financial statements. General purpose financial statements are prepared as per general purpose framework. Special purpose financial statements are prepared as per special purpose framework. But in order to make this discussion complete, first we need to understand what is this general purpose framework and what is this special purpose framework. General purpose framework means it refers to such a framework which fulfills financial information needs of various users of financial statements. If the single framework, the set of rules and regulations which you are following, if they have the capability to fulfill financial information needs of various users of financial statements, if a set of rules and regulations which you follow, if that set of rules and regulations are having capability to fulfill financial information needs of all the users of financial statements simultaneously, that framework we call it as general purpose framework. Let me give you example, but before I can give you example, we have to understand, we have to just quickly go through who and all are various users of financial statements. Management will prepare financial statements, but who will use these financial statements? Like if we take a list of the people who use the financial statements, number one, shareholders will make use of financial statements. Why they will use the financial statements? Because they want to know whether the company in which they have invested the shares, is that company making profits or is it making losses, assets are increasing, assets are decreasing, what is its net worth. Shareholders wants to track these details, and the only source of information through which shareholder can track this information is financial statements. So shareholder are one of the users of financial statements. They want to know about profitability and performance. Management also will use financial statements. Management will prepare. They will also use it. How come they will use it? For their decision making purpose, whether to continue the business or close down the business, whether to declare the dividend or reinvest the profits. So that decisions will be taken by the management on the basis of financial statements. Banks and financial institutions will use the financial statements to decide whether a loan can be given to an entity or not. Banks or financial institutions will use. Your creditors will use it to decide whether to sell the goods on credit basis or not, whether the company is a credit worthy company or not. How the creditors will come to know? By reading the financial statements. And even government will use financial statements. Why government will use financial statements? To know whether the entity is properly depositing the taxes, whether they are depositing correct amount of taxes or not. This even government wants to know. And how the government will come to know about it? By going through the financial statements. And even not just this financial statements will even be used by some entities like insurance companies, etc., for settlement of insurance claims, trade disputes, etc. Debtors want to use the financial statements because the debtors want to know the future viability. Before they can enter into long-term contracts with the company, they want to know future viability. Your customer wants to know whether this company can continue in the future or not. And not just that, there will be some research scholars, research analysts in the market. That research analysts like stock brokers, they will also use the financial statements for preparing their project reports. So like this, financial statements will be prepared by the management, and the same financial statements will be used by these many users for different purposes. Now, do you think the management of the companies will prepare separate set of financial statements for each of this user? For shareholder, different set of financial statements. For management, different set of financial statements. For banks, different set of financial statements. Do you think they will prepare different sets of financial statements? No. If you take Reliance Industries Limited, they will release one set of financial statements which are prepared as per Schedule 3 and accounting standards. Once they release these financial statements, the single set of financial statements will be used by shareholder, it will be used by management, it will be used by creditors, it will be used by the governments, it will be used by the debtors, it will be used by various other users. So if you observe, we followed one rule here, which is Schedule 3 and accounting standards, and this framework is capable to meet the financial information needs of so many users of the financial statement simultaneously. If you observe carefully here, the management prepared the financial statements using one framework. What is that? Schedule 3 and accounting standards. Now that set of framework, that one set of framework is used to fulfill the financial statements of all the users. If you go and give that financial statements to the shareholders, they will agree. If you go and give it to the management, they will agree. If you go and give it to the government, they will agree. If you go and give it to the debtors, they will agree to that. So this single set of framework is going to fulfill financial information needs of so many users of the financial statements simultaneously. So that framework, we call it as general purpose framework. One of the best example of the general purpose framework is Schedule 3 and accounting standards. Why? Because Schedule 3 and accounting standards will fulfill financial information needs of various users of the financial statements. Clear? And those financial statements which are prepared as per this general purpose framework, that we call it as general purpose financial statements. Clear? So now it becomes necessary for us to understand what is special purpose framework. See, if general purpose framework is the framework which fulfills financial information needs of various users of financial statements, then what will be the special purpose framework? What could be the definition of the special purpose framework? Yes, whatever comes to your mind. So smart people, the definition you would have already made it. So what is the definition which has come to your mind? The framework which fulfills financial information needs of specific users of financial statements. The framework which fulfills financial information needs of specific user, just one or two users financial information. If the framework is fulfilling that information, we call it as, that framework we call it as special purpose framework. The framework which fulfills financial information needs of specific users of financial statements, just one or two users of financial statements information will be fulfilled by you following some framework, that we call it as special purpose framework. Like for example, when the entity X Limited went to the banker for the purpose of the loan, the management approached the banker and told, sir, we need 100 crores of loan. Now the banker told to the company that, sir, if I have to give the loan of 100 crores for you, I want you to prepare the financial statements on cash flow basis. What the banker asked, sir, if I have to give you the loan, you prepare the financial statements on cash basis, not on accrual basis. As we know, general financial, normal financial statements, Schedule 3 and accounting standard financial statements will be prepared on accrual basis. But what the banker is asking is, sir, if you expect me to give you the loan, I will give you loan. But what I want is, you prepare the financial statements on cash basis and bring it to me, then I will give you loan. Now, why the banker will ask you for this is, there is a logic. Why? Because your accrued profit will not determine your repaying capability. Your cash profit will determine your repaying capability. If the financial statements are prepared on accrual basis and in the statement of P&L 5 crores of profit is there, can you give me a guarantee if the financial statements are prepared on accrual basis, will this 5 crores would have been completely realized in cash? May or may not be. We can't give that guarantee. This 5 crores might have been realized in cash or might not be realized in cash. But this 5 crores, this accrued profit of 5 crore rupees will not determine your repaying capability. You assume you have an accrued profit of 5 crores, but out of this only 3 crores is realized in cash. You have an installment to pay 4 crore rupees. Will you be able to pay? No. Why? Because you have realized only 3 crores. So banker is well aware that repaying capability will not be determined by accrued profits. The correct repaying capability will be determined by cash profits. So that's why banker has asked the company to go and prepare the financial statements on cash basis, then he will give you loan. Now, X Limited company has prepared the financial statements on cash basis, gave it to the banker. Banker gave the loan on the basis of cash basis of financial statements. Now, if the X Limited company take these financial statements which are prepared on cash basis and give it to the government for payment of taxes, will the government accept? No. If the company takes these financial statements prepared on cash basis, give it to the shareholder, will the shareholder accept this for decision making? No. If I go and give it to the creditors, will they accept? No. If I go and give it to some insurance companies, etc., will they accept this cash basis of financial statements? No. Here the company followed a framework which is cash basis, and that framework is fulfilling information needs of only one specific user, who is banker here. So this framework we call it as special purpose framework. The framework which is fulfilling information needs of just a specific user, not all the users simultaneously. So this framework, special purpose framework, which is prepared on cash basis of financial statements, that is fulfilling information needs of only banker, not any other user. This we call it as special purpose framework. Whereas if the framework is ready to fulfill financial information needs of various users simultaneously, that we call it as general purpose framework. Clear, everybody? And this general purpose framework, if it is getting accepted by so many users simultaneously, why it is getting accepted by so many users simultaneously is general purpose framework is having some characteristics. General purpose framework is having some what? Characteristics. What characteristics it is having? So the characteristics of the general purpose framework are, they are prepared on the basis of fundamental accounting assumptions. They follow fundamental accounting assumptions. They follow generally accepted accounting principles. They follow accounting standards, and the general purpose financial statements are prepared periodically. for a fixed period they will be prepared, and that periodicity in India is annually, which starts from 1st of April and which will end on 31st of March. So general purpose framework or general purpose financial statements will have 4 characteristics which will make them accepted by all the people, and those 4 characteristics are: they follow fundamental accounting assumptions, they are prepared as per GAAP, they are prepared as per accounting standards, and they are prepared periodically. Clear? So we revised 2 kinds of framework on the basis of purpose. One is general purpose framework and the other one is special purpose framework. Clear, everybody? There is even one more categorization of the frameworks on the basis of presentation. The 2 kinds of frameworks which we have seen just now are on the basis of purpose of the financial statements. But as I was telling, there is even one more different kinds of frameworks now on the basis of presentation of financial statements. So on the basis of presentation of financial statements, frameworks are once again divided into 2 categories. One is compliance framework and the other one is fair presentation framework. So let us try to revise now what is the meaning of the compliance framework and what is the meaning of fair presentation framework. First, talking about compliance framework, it has been defined as, it refers to such a framework where financial statements are prepared according to the requirements of framework without any deviation. How the term compliance framework has been defined? It refers to such a framework where the financial statements has to be prepared according to the requirements of the framework without any deviation. That means in case if the framework is strictly asking you to follow the requirements, they are not giving you any scope of a deviation. That kinds of frameworks we call it as compliance framework. Like as you could see here, the definition has been given: the framework in which the financial statements are prepared as per the requirements of such framework without any deviation. Deviation is not at all permitted. Whether by following that rules and regulations you get a true and fair view, you do not get a true and fair view, all that doesn't matter. What you are only supposed to do is whatever mentioned in the framework, strictly you have to follow. Whether they give true and fair view, that doesn't matter. Whatever is mentioned, you have to follow as it is. Like if you look at the example from the compliance framework, here banker asked me to prepare the financial statements on cash basis. And I actually prepared the financial statements on cash basis. But I know that by following cash basis of accounting, the financial statements will not give true and fair view. By following cash basis of accounting, I know that financial statements will not give true and fair view, but I strictly followed without any deviation. Why? Because if I prepare, then only banker will give me loan. So like this, if compliance framework refers to that kind of frameworks where you are supposed to strictly follow the requirements of the framework and deviation is not at all permitted. In any case, you should not deviate. Strictly you have to comply with. But fair presentation framework, as the name itself says, in this framework also, we try to prepare the financial statements as per the requirements of the framework only. But in the fair presentation framework, the management will be given a permission to provide additional disclosures, beyond the requirements of framework, or the management will be permitted to altogether deviate from the requirements of the framework so as to achieve fair presentation. So what is this fair presentation framework? In the fair presentation framework also, the management will try to prepare financial statements as per the requirements of the framework. But here you are given some freedom. Here you are given an option. What option you have been given? The management has been given the freedom to provide extra disclosures, extra explanation in the notes to accounts, which are beyond the requirements of the framework. That means you can give extra disclosures which are not given in the framework, or we can even altogether deviate from the requirements of the framework. That means we can ignore whatever has been mentioned in the framework and we can follow something else which is not there in the framework. But for what purpose we have been given the freedom to provide additional disclosure or deviate? For what purpose this freedom is given? To achieve fair presentation. Here the main focus is not just on following, here the main focus is on achieving the fair presentation. Sir, how to give additional disclosure or how we can deviate from the requirements of the framework? So let me give you an example. Assume that an entity has bought some plant and machinery costing some 1 crore rupees of money. And as we all know, if the company is buying a fixed assets, it need to be depreciated. And if you go by the Companies Act, only two methods are permitted for providing depreciation. Either you have to follow SLM method or you have to follow WDV method. And even rates are also prescribed under Companies Act itself. If you follow SLM, depreciation rate will be 10%. If you follow WDV, depreciation rate will be 15%. Assume residual value as 0 for the sake of convenience in the discussion. So if you have to follow the requirements of the framework, if you have to follow Companies Act, either you have to follow SLM method or WDV method. If you follow SLM, the depreciation will be 10 lakh rupees. If you follow depreciation, if you follow WDV method, the depreciation will be 15 lakh rupees. If you follow the framework, if it is a compliance framework, we have to follow this strictly. Either we have to follow SLM or we have to follow WDV. If we are not at all permitted to deviate, either we have to follow SLM or WDV at the rates given here, then we call it as a compliance framework. Now, let me give you one extra information regarding the usage of the machinery. See, the usage of the machinery, this plant and machinery was designed in such a way that this machinery will be exactly produce 1 lakh units. This machinery was designed in such a way, it will produce exactly 1 lakh units. After producing 1 lakh units, it will stop working. Now in year 1, the manufacturing, the company has actually produced 20,000 units out of that machinery. The total capacity is 1 lakh units. But in year 1, the company has already used that machinery to produce 20,000 units. So if you observe carefully here, by looking at the usage of the machinery, one more method of depreciation will be appropriate here, which is production units method. Yes or no? Why? Because production units method reflect the actual consumption pattern. So it is a general rule that the depreciation method should reflect actual consumption pattern of the machinery. So now Companies Act is saying either follow SLM method or WDV method, but looking at the consumption pattern, not SLM, not WDV, production units method is a better measure of depreciation. But if the framework is a compliance framework, you are not supposed to follow production units. Whether it gives a true and fair view or not, we have to follow either SLM or WDV. So if no freedom is given for you to deviate from the requirements or to provide extra disclosure, that we call it as compliance framework. But in case if the freedom has been given for you, in order to achieve fair presentation, if the framework is giving you freedom, what freedom? To either provide additional disclosure beyond the requirements of the framework, or even the freedom has been given for deviating the requirements of the framework altogether. Sir, how can I provide additional disclosure, sir? Additional disclosure can be provided like in the statement of P&L, I will charge depreciation either as SLM or WDV only. Either I will charge a depreciation as 10 or 15 lakhs only. But in the notes to accounts, I will add extra note. In the notes to accounts, I will add an extra explanation. What explanation I will add there is, since the Companies Act is asking me to follow SLM or WDV, I have charged depreciation as per SLM or WDV. But keeping in mind the consumption pattern of the machinery, neither SLM nor WDV will be appropriate. Production units method would have been much more appropriate. And if I follow production units method of depreciation, the depreciation would have been 20 lakh rupees and my profit would have been this much. This is giving much more fair presentation than SLM or WDV. But since Companies Act is asking me to follow SLM or WDV, I have followed it, but this will give me fair presentation. So if you observe, I am giving an extra explanation, extra disclosure in the financial statements, which is not a requirement of the framework. I am giving what? Extra explanation. Why you are giving this extra explanation? Why? Because it will help the users to understand the fair presentation. So if the framework is giving you freedom to provide disclosures beyond the requirements of the framework, or altogether the framework is giving me the freedom to deviate. If I deviate, what I will do is in the statement of P&L itself, I will directly charge the depreciation 20 lakhs. I will not follow either SLM, I will not follow either WDV. Directly on the face of the P&L, I will charge the depreciation as per production units method only. Here if you observe, I have deviated from the requirements altogether. And why I have deviated from the requirements? Why I have deviated from the requirements is to achieve the fair presentation. I want to achieve fair presentation. For that purpose, I have altogether ignored whatever is mentioned in the framework and I am following something else to achieve fair presentation. So if the freedom has been given in the framework, either to provide additional disclosures or to deviate from the requirements of the framework to achieve fair presentation, that we call it as fair presentation framework. On the other hand, if no freedom is given for deviation, if no freedom is given for additional disclosure, we are supposed to follow strictly as it is whatever is given in the framework. Not even 1% scope is given for deviation. That we call it as compliance framework. The name itself says you have to comply, you have to follow strictly. Whereas if in the framework they are giving the freedom either to provide additional disclosures beyond the requirements, or if they are giving me the freedom to deviate from the requirements if required to achieve a fair presentation, that framework I call it as fair presentation framework. Clear everybody? And few more points to clarify here. Most of the special purpose financial statements will be prepared as per compliance framework, and most of the general purpose financial statements will be prepared as per fair presentation framework. What is one more point we need to keep in mind? Most of the special purpose financial statements are prepared as per compliance framework, and most of the general purpose financial statements will be prepared as per fair presentation framework. The logic is very simple. When I said general purpose financial statements, it has to fulfill financial information needs of so many users. No, when so many users will be satisfied when they give a true and fair view, or when they don't give a true and fair view? When they give a true and fair view. And where the true and fair view is possible? Only in the fair presentation framework. And one more point of difference here: in compliance framework, true and fair view might not be guaranteed. We cannot guarantee the true and fair view, but in the fair presentation framework, there will always be a true and fair view. So these are the types of frameworks on the basis of presentation. Compliance framework without any deviation, true and fair view will not be guaranteed in the compliance framework, and most of the special purpose financial statements will be prepared as per compliance framework. Coming to the fair presentation framework, here there will be freedom given for providing extra disclosures beyond the requirements of the framework, or even sometimes freedom will be given to deviate from the requirements of the framework altogether, with the main objective of achieving fair presentation. And in the fair presentation framework, there will always be a true and fair view, and most of the general purpose financial statements are prepared as per fair presentation framework. Clear everyone? So I have a question here. Whatever financial statements which every company is releasing, like you can download the financial statements of Reliance Industries Limited. They will be available in their official website. You can download the financial statements of Infosys company. Not just that, there will be so many other companies. All the listed companies will release their financial statements. They will keep it available in the public domain. Now, according to which framework all the companies are releasing the financial statements? What framework which they follow in all these financial statements of the companies released? Like Reliance will release the financial statements, Infosys will release the financial statements, TCS will release the financial statements. Will they follow compliance framework, or will they follow fair presentation framework? So whatever financial statements which are released by the companies, whatever financial statements which we will prepare for the general companies, they are as per fair presentation framework. Why? Because Section 129 of the Companies Act, which is talking about financial statements, they say that financial statements shall be prepared as per Schedule 3 and accounting standards, but at the same time they shall give true and fair view also. So what Companies Act has put the focus? They ask you to prepare the financial statements as per Schedule 3 accounting standards, but at the same time they will even ask you to give they will even ask you to prepare financial statements as per true and fair view. And as we all know, where there will be true and fair view, in the compliance framework or fair presentation framework? In the fair presentation framework. And even if you do a in-depth understanding of Section 129 of the Companies Act, in one point they say that, let me show you the bare section of that Section 129 of the Companies Act. Section 129. I will show you, I will give justification why the financial statements as per Companies Act are prepared as per fair presentation framework. So if you go through one particular subsection, which is actually subsection 5. So if you read, not subsection, subsection 5 only. So let me zoom out. So I hope you are able to see it here. So if you see this subsection 5 of section 129, they say that without prejudice to subsection 1, ignoring whatever has been mentioned in subsection 1, where the financial statements do not comply with the accounting standards, then the company shall disclose in the financial statements the deviation from accounting standards. Nothing but by way of subsection 5, 129 subsection 5, the Companies Act itself is giving the freedom to the companies. In case if you don't want to comply with the standard, don't comply, but tell the reasons in notes to accounts. That means indirectly section 129 of the Companies Act is giving the freedom to the companies to deviate from accounting standards. So that's why whatever financial statements which every company is releasing in the public domain, all that are fair presentation framework. Why? Because section 129 of the Companies Act has given the freedom to the companies to deviate from the accounting standards if required. Clear? So where are all discussion regarding the frameworks has started? So we are discussing objectives of the auditor. In that second objective we have discussed, which is whether financial statements are prepared as per applicable financial reporting framework. But we did not discuss at the first objective, which is financial statements are free from material misstatements or not. Now we need to understand what is this material misstatement. First we will understand the term misstatement. See, misstatement means very simple. If I have to put it in simple terms, misstatement in the financial statement means simply a mistake in the financial statements. But we as all know, simple things don't work in the exam. So we have to write a complex definition, which we will simplify later, then only we'll get the marks. So simply if I put it, misstatement means a mistake in the financial statements. But that is not how the term misstatement is defined. It is defined something like this: a difference between amount, classification, presentation, disclosure, which is there in the reported financial statements, and amount, classification, presentation, disclosure required as per applicable financial reporting framework, if they are not matching. So if you look at the definition of misstatement, how they have defined the term misstatement is the difference between amount, classification, presentation and disclosure, which is there in the reported financial statements, and the amount, classification, presentation, disclosure, which is there as per applicable financial reporting framework. Nothing but applicable financial reporting framework is asking the company to do something, but the management in the financial statements which they have prepared, they are doing something else. That difference could be in amount also. That difference could be in classification. That difference could be in presentation. That difference could be in disclosure. Like some accounting standard is asking you to recognize the revenue as 90,000 rupees. But the management in the financial statements which they have prepared, they have recognized the revenue as 1.5 lakh. So difference in amount. Which amount? Amount which is there in the financial statements, amount which is required as per applicable financial reporting framework. This difference we call it as misstatement. Or applicable financial reporting framework, some accounting standard is expecting the management to treat certain item as revenue expenditure, but the management in the financial statements, they are treating it as a capital expenditure. Difference in classification. Or applicable financial reporting framework like schedule 3 is asking you to present the financial statements in the vertical format, but management, they have made a difference in the presentation. They follow T format, difference in presentation. Or some accounting standard is asking the management to give some explanation in the notes to accounts, some disclosure in the notes to accounts, but management in the financial statements in which they have prepared, either they did not give that explanation or they have given that explanation in a wrong manner. Disclosure means nothing but an explanation in the notes to accounts. So even if there is a difference in the disclosure, that also we call it as a misstatement. So nothing but, if I have to put it in simple terms, applicable financial reporting framework is asking you to do something and management has done something else in the financial statements. That difference could be in amount, that difference could be in classification, that difference could be in presentation, that difference could be even in disclosure. That's why I say, whenever we say mistake in the financial statements, we generally imagine that profit is wrong, assets are wrong, sales are wrong. This is what we imagine. But misstatement need not always happen only in amounts. Misstatement can even happen in the notes to accounts also. If the management does some mistake in the notes to accounts, that is also a mistake in the financial statements. Change your perception. Don't restrict your thinking. So we generally imagine misstatement means only which will happen in amounts. Amount is wrong, profit is wrong, sales are wrong. No. A misstatement can even happen in the notes to accounts. An explanation which is given in the notes to accounts also might contain a mistake. Clear? Now, they are not just saying misstatement, but they are saying something else, material misstatement. But before that, one more thing here. A misstatement can happen because of two reasons. Misstatement can happen because of fraud also. Misstatement can happen because of error also. And as we all know, the differentiating factor between the two is intention behind it. Fraud is something which is always intentional. Error is something which is unintentional. That's the underlying difference between the two. And now if we come back to the objective, they are not just saying misstatement, they are saying material misstatement. Now what is the meaning of this term material? So material means significant or important or major. Nothing but, as an auditor, you should not be concerned about each and every misstatement in the organization. You should be concerned only with the material misstatement. But the $1 million question here is, when we call misstatement as a material. When we call a misstatement as a material, there is no exact definition, but what the standard has suggested is a misstatement will be considered as material if it could influence decision of users of financial statements. How the term material has been defined? Material misstatement. So material means significant or important. A misstatement will be considered as material if it influences, if it is having a capacity to influence, if it is having a capacity to affect the decision of user of financial statements, that I call it as material. Like for example, I am a shareholder of Reliance Industries Limited. I came to know that in the Reliance Industries Limited 1 crore of fraud happened. Now, but the moment I came to know that 1 crore fraud happened in the Reliance Industries Limited, will I immediately sell the shares of the company? Definitely not. Reliance is of the size of 6 lakh plus crores of the company. 1 crore will not even come in the rounding off also. Reliance will prepare the financial statements which are rounded off to crores. So crores will go in rounding off itself. So I came to know that there is a misstatement, but is it affecting my decision? Is it making me to sell the shares? No. So this is a misstatement, but it is not having a, but it is not capable to influence the decision of user. So I will not call this as material. There is a misstatement, agreed, but it is not having the capacity to influence, to change the decision of user who is shareholder here. So should I auditor be concerned about this 1 crore of fraud? Not required. Why? Because it is not at all material. On the other hand, if I am conducting audit of 100 crores of company, in that company, if I came to know that 1 crore of fraud has happened, now this will become material. 1 crore is not material in Reliance because the size is so big, 6 lakh plus crores of turnover of a company. But if the same 1 crore fraud has happened in 100 crores turnover of a company, then I will call it as material. So the point which I want to make here is materiality is a relative term. Materiality is what? It is a relative term. It is, we can't absolutely define it. Materiality is a relative term. Relative means what? Which changes from facts and circumstances of each and every case. What do you mean by relative? The fact which changes by circumstances, the item which changes by circumstances. I will quote one simple thing which has, I will quote one simple example which has been quoted by Albert Einstein to explain the matter of relativity. So you know what Albert Einstein told regarding relativity? He tried to explain in one funny way. So relativity means if you spend 1 hour reading some book, 1 hour feels very lengthy time. But if you spend the same 1 hour with talking with some pretty girl, now that 1 hour will feel like just 5 minutes only. This is not example created by me. This is what the example created. This is what the example told by Albert Einstein to explain the concept of relativity. See, imagine if you are spending 1 hour in reading the book or in reading this auditing material, it will feel like a hell for you, that 1 hour. But if you spend the same 1 hour talking with some pretty girl or boy, if you are spending this 1 hour of time for talking with some pretty girl or a boy, the same 1 hour will feel just like a time of 5 minutes of time. Yes or no? So this is what the meaning of relativity. So if you feel 1 crore as material in one small company, the same 1 crore might not be material in another company. Understood everybody? So materiality is a very relative term, the perception which changes from facts and circumstances of each and every case. Clear everybody? So this is what the meaning of the term material. So as an auditor, we need to express an opinion whether the financial statements are free from material misstatements. Free from material misstatements means what? Whether they should contain a misstatement or they should not contain a misstatement. They should not contain a misstatement. On that I have to express opinion. What should not contain material misstatement? Financial information. So with this we are done with objectives also, the 2 objectives, and as a part of that objective we have covered various concepts. One last topic I have to revise in the concept of this introduction to the auditing, which is the meaning of the term auditor. Who is auditor? Simply the person whoever is doing the audit, we call him as auditor. And when I say a person whoever is doing the audit will be called as auditor, generally when we go for audit, a single person will not go and complete the audit. A single person single-handedly will not go and complete the audit. Whenever we say we are going for audit, we go as a team. And who will be there in this audit team means engagement partner, nothing but head of the firm. If I have to put it in even simple terms, whoever is signing the audit report, that person will be called as engagement partner. And also engagement partner, if I am an auditor, if I am a chartered accountant in practice, if I was allocated some audit, I will not go single-handedly and complete the audit. I will take the staff along with me. So myself will be called as engagement partner. Along with me, I will take some article assistants, senior article assistant, junior article assistants. Along with that, I will take a people called paid assistants. And along with them, some other people in my firm will be there whom I give a designation called audit manager. Sometimes I will give other designations like project manager. So like that, whenever I go for audit, I will not go single-handedly. I will take my entire team along with me. So assume I was allocated audit of the client X Limited. For this client's audit, we as a team are going. Myself being an engagement partner, one article assistant, one senior article assistant, one junior article assistant, two paid assistants, and one audit manager. So a team of how many people? 1, 2, 3, 4, 5, 6. A team of 6 people we are going and conducting the audit engagement of the client X Limited. Now we 6 people collectively will be called as engagement team. What we 6 people will be collectively called as engagement team will be called as. The point why I am saying this is, when I say auditor, auditor just doesn't mean one person. Auditor means entire team. So wherever you are reading the term auditor, auditor doesn't mean just one person. This entire engagement team, whoever is going and doing the audit, they all will be collectively referred as auditor. Auditor is not just one person. The entire engagement team will be collectively called as auditor. But in two circumstances, auditor means only engagement partner. In how many circumstances? In two circumstances, when they refer auditor, in that two circumstances, auditor means only one person, engagement partner. Sir, what are the two circumstances in which auditor means only engagement partner? Two circumstances are, number one, acceptance of responsibility, and number two, accountability before regulatory authorities. In two circumstances, that is, number one, when you are required to take an responsibility, when it comes to acceptance of responsibility. Number two, when you are accountable before regulatory authorities. In those two circumstances, auditor means only engagement partner. As you could see, acceptance of responsibility and accountability before regulatory authorities. This simply means, if somewhere it was mentioned, auditor shall sign the audit report. That is the matter relating to responsibility. When I say auditor shall sign the audit report, can an article assistant sign the audit report? No. Why? Because this is a matter relating to acceptance of responsibility. Here, article assistant cannot say, our auditings are told that engagement team includes even article assistants. All auditor means engagement team, and I am a part of engagement team being an article assistant. So I am also coming under definition of auditor. I will sign the audit report. Can the article assistant sign? No. Why? Because when I say auditor has to sign, by signing you are taking responsibility. Since it is a matter relating to acceptance of responsibility, auditor shall refer to only engagement partner. So that's why somewhere it was mentioned, auditor is responsible for this, auditor is responsible for that. Their auditor doesn't mean entire engagement team. Their auditor means only engagement partner. And number two, when it comes to acceptance of responsibility before regulatory authorities, when you have to be accountable before regulatory authorities, like for example, if someone is if somewhere it was mentioned, auditor will be liable for imprisonment. Accountability, you are responsible. If somewhere it was mentioned as if auditor does something wrong, auditor has to face a imprisonment of 2 years. Now, if people have come for arresting the auditor, police has come, a case was proven, judgment was passed, auditor should be arrested and kept in jail for 2 years. Now, people have come for arresting the auditor. At that point of time, engagement partner is not there. Can they take the article assistant and keep him in jail for 2 years? No. Why? Because it is a matter relating to accountability before regulatory authorities. If they are saying auditor is accountable for so and so thing, auditor is responsible for imprisonment, their auditor means only engagement partner. Understood? So in two cases, acceptance of responsibility and accountability before regulatory authorities, auditor means only engagement partner. In rest of all the cases, auditor means entire members of engagement team. Auditor means what? Entire members of engagement team will be collectively called as auditor. But in two cases, acceptance of responsibility and accountability before regulatory authorities, auditor means entire members of the engagement team. Clear? Understood? So this is what the concept of fundamentals of auditing or introduction to the auditing. Clear everybody? That's all guys. So now we will try to start with the chapter nature, objective and scope of audit. So since we are done with the introduction to the audit, the next topic which we will be revising is nature, objective and scope of audit. This in fact I will say the first chapter. The chapter which we completed, introduction, that is just a basic discussion. You will not be able to find a chapter called introduction to auditing in the study material of ICI. This is something which we have created to make you aware of the topics which you need to understand, the terms which you need to understand for having detailed understanding of the subsequent topics. So with that objective, this particular chapter called Introduction to Auditing has been introduced. Now let us let us start revising the chapter named Nature, Objective and the Scope of Audit. So here, as you could see, this is what the chapter, very simple chapter, very easy chapter, very fundamental things will be there. Let us try to have one quick revision of this particular chapter. So first, I will try to start revising with the different kinds of audit. See, practically speaking, let me ask you one simple question before I start this. Is audit mandatory for each and every organization? Is audit of the entities legally mandatory for all the organizations? The answer is straight away no. Audit is not legally mandatory for all the organizations. So depending on applicability of law, depending upon the requirements of the law, audits are broadly divided into two categories. Depending on requirements of law, the audits are broadly divided into how many categories? Two categories. Let us see what are they. So the two types of audit are number one, statutory audit, and number two, non-statutory audit. So as we all know, the statutory audit, statute means requirement of laws and regulations. So those audits which are mandatorily required under any law for the time being in force, that we call it as statutory audits. So those audits which are mandatorily required as per the time being in force, as per any law for the time being in force, those audits we call them as statutory audits. Like if I have to give you examples for statutory audits, number one, company audit, which is actually mandatorily required under Companies Act 2013. I will say cooperative societies audit, which is required mandatorily under Cooperative Societies Act 2000, Cooperative Societies Act, and even we have this bank audit, which is mandatory under Banking Regulation Act. So like that, those audits which are mandatorily required under any law for the time being in force, that we call it as statutory audit. Whereas when I say non-statutory audit, the name itself says these audits are not mandatorily required under any law for the time being in force, but client voluntarily on his own choice, if he is coming and voluntarily getting the accounts audited, that we call it as a non-statutory audit. So examples of this audits are sole proprietors audit or partnership firms audit, or any other entity you take where the audit is not mandatory but the client is voluntarily getting the accounts audited, that we call it as non-statutory audit. And you might get a doubt here, sir, even though audit is not mandatorily required by any law or organization, why do clients voluntarily come and get their accounts audited, sir? Why? Because by conducting audit, there will be various advantages. Audit of financial statements will give you various advantages. So what are the various advantages which will be there if any client gets their financial statements audited? Number one, it will protect the interest of the shareholders. Let me take you through that question simultaneously. So what are the advantages of independent audit? Number one, it protects the interest of the shareholders. Like as you could see here, this particular answer, it safeguards the financial interest of the people who are not associated with the management. So you have to be very careful here, guys. Assume a true or false statements they are asking. It safeguards the audit of financial statements, safeguard the financial interest of the people who are associated with the management. Do you agree with that statement? No, the answer is false. The audit of financial statements protects the interest of the people who are not associated with management. Similarly, if you get the accounts audited, it acts as a moral check on the employees. It acts as a fear in the minds of the employees of the client from committing frauds or errors. It is helpful for settling liability for taxes. That means government will use your audited financial statements to determine whether you made the correct payment of taxes or not. And even it is helpful for negotiating the loans. If you have audited financial statements ready, you can directly go to the banker and have a better negotiation for the loans. And audit of financial statements will help in the settlement of trade disputes, insurance claims, etc. It is helpful for detection of wastages and losses which are happening in the organization. It is helpful for the client to find out whether necessary books of accounts are maintained by them or not. It is even helpful at the time of settlement of accounts, especially in the case of partnership firm at the time of admission or death of a partner. And finally, government also may require audited financial statements before they give any assistance like grants, etc. And even for giving businesses licenses for certain businesses also, government will ask you audited financial statements. So if you get your financial statement audited, these will be various advantages which company will enjoy. That's why any entity will enjoy. That's why even though the audit is not mandatory, some clients come and get their accounts audited. So those audits we call them as non-statutory audits. So like this, on the basis of requirements of the law, audits are divided into two categories: statutory versus non-statutory. Now, few more points to differentiate between the statutory audit versus non-statutory audit. In the case of statutory audit, scope, objectives, that is what are duties of auditor, what are rights of auditor, what are duties of management, what are rights of management. So all these things will be decided under respective law. All these things will be decided under respective law. That means under whatever law the audit has been made mandatory, the same law will even tell you what and all will be your duties and responsibilities. Whereas when it comes to non-statutory audit, the duties and responsibilities, and that is scope and objectives of the auditor, will be decided by appointing authority through terms of engagement. Simply, whoever is appointing you, those people only will decide what will be your scope and objective. In which audit? In the case of non-statutory audit. Whereas when it comes to statutory audit, who will decide the scope and objective? They say respective law, and also they say terms of engagement. Which means in the case of statutory audit, law will decide the terms and conditions. But if the parties to the audit, that is if the client and auditor, if they want to extend the scope and rights of the audit, the scope and objective of the audit, they can extend it by way of mutual agreement. But in any case, the scope, the objective, which is already decided under law, can never ever be reduced. Those are bare minimum. If the parties to the contract, like if the client and auditor wants, they can extend the scope in the case of what? Statutory audit. But when it comes to non-statutory audit, exclusively the client will decide. There is no law interference there. But when it comes to statutory audit, first law will decide. But if the client and auditor want, they can extend the scope in the case of statutory audit, but they can never ever reduce the scope which is already decided. The scope decided by the law is bare minimum. Clear, everybody? Next one. So these are the main differences between statutory versus non-statutory audit. So we have covered two concepts, the differences between statutory versus non-statutory. As a part of that particular answer, we have even revised what are the advantages of independent audit also. Now, sometimes they will ask you a question: if you are doing audit, how you will satisfy yourself that financial statements are not misleading? Or even they might alternatively ask you a question: what are the factors which are required to be considered by the auditor before expression of an opinion? So that is what the question number here, question number 1 here, if you are able to see, they ask a few things here. Define the term audit, explain the points which the auditor should consider before expression of an opinion. Or even they might ask you a question alternatively: what are the factors which auditor should consider before expression of opinion? Or they might ask you a question: how the auditor would satisfy himself that financial statements are not misleading? So in multiple ways they can ask you the question. Now what answer you are supposed to write? What are the points which you will consider before expression of an opinion? So shall we have a look at it? Let us do it. See, very simple guys, common sense you need to apply here, nothing else. Just a minute. Before I explain you about what are the points to be considered before expression of an audit, let me ask you, what is the main purpose of the audit? See, the main purpose of the audit, why audit as a function has been introduced, is to enhance, to increase the confidence of users of the financial statements. Why audit as a function has been introduced? The purpose of audit is to increase the confidence of the users of the financial statements. See, management does various activities in the organization. They will only prepare the financial statements. If those financial statements are directly given to the shareholder will not have confidence on those financial statements. He will not be able to comfortably take the decisions. So that's why what industry has thought is, once the financial statements prepared by the management, before they reach the ultimate user, in between, some independent party, independent qualified person like a chartered accountant should verify whether the financial statements are reliable or not. And if he expresses the opinion, that opinion will increase the confidence of users of financial statements, then they can comfortably make the decisions. So the purpose of audit is to increase the confidence of users of the financial statements. And also, auditor's opinion is not a guarantee. Auditor is just expressing an opinion. It is not a guarantee. It cannot be taken as guarantee regarding two things. So auditor's opinion is not a guarantee regarding future viability of the entity. Auditor has nothing to do with the future of the company. Auditor's opinion cannot be taken as a guarantee that the auditor is giving certification that company will continue in the future. No. So if I am giving positive opinion, nobody can take it as granted that I am saying company will continue comfortably in the future. No, we are not giving that guarantee. Our opinion has nothing to do with the future viability of the company. So that's why they say auditor's opinion is not a guarantee regarding future viability of the entity. At the same time, auditor's opinion is also not a guarantee regarding efficiency and effectiveness of management. Auditor's opinion is also not a guarantee regarding efficiency and effectiveness of management. When I gave a positive opinion, I am not saying that management are very honest, management are effective, superb management. No, I have nothing to do with the efficiency and effectiveness of management. When I am giving opinion, my opinion is just related to historical financial information, and that too I am giving only opinion. My opinion is not a guarantee for future viability of the entity, and even my opinion is not a guarantee regarding efficiency and effectiveness of management. So that's what the implications of auditor's opinion. Now coming to the main answer, which is what points are to be considered by an auditor before expression of an opinion. Very simple. First thing, I need to check whether the financial statements are matching with the books of accounts. As we all know, the financial statements are prepared on some source data. And what is the source data for the preparation of financial statements? Books of accounts. So as an auditor, first point which I need to satisfy myself is whether the financial statements are matching with books of accounts. Next one, second point, whatever entries which are there in the books of accounts, they should be supported by sufficient and appropriate audit evidence. First thing I need to check, financial statement should match with books of accounts. Second thing, whatever entries in the books of accounts are there, they should not be just written out of the air. That entries in the books of accounts should have sufficient and appropriate audit evidence. Like if I have seen a purchase general entry in the books of accounts, I need to have a supporting document like a bill or invoice. If I find a rental entry, rent payment entry in the books of accounts, I need to have a supporting document like a rental agreement. If I am able to find an entry for payment of insurance premium in the books of accounts, I need to have a supporting document like an copy of insurance policy. So like that, every entry in the books of account should be supported by sufficient and appropriate audit evidence. And next one, none of the entries should have been omitted. I should make sure that there are no omissions. At the same time, nothing which is not in the books of accounts has been found in the financial statements, nothing but fictitious entries. So if I put it in simple terms, third point which I need to satisfy here is there should not be any omissions. At the same time, there should not be any fake entries. Only genuine entries should be there. Number 4, information conveyed in the financial statement should be clear and unambiguous. Whatever information that is getting presented in the financial statements, that should be clear, unambiguous, that should be understandable, which should not create any kind of confusion. The information in the financial statement should give clarity, it should not create confusion. That I need to check. And the financial statements are properly classified, described and disclosed in conformity with accounting standards. Nothing but whether the financial statements are prepared as per accounting standards or not, that also I need to check. And finally, whether the financial statements give true and fair view of operational results, nothing but profit or loss, and also assets and liabilities. So these are the 6 points which I as an auditor consider before expression of an opinion. So what are that 6 points, guys? Number 1, financial statements are matching with books of accounts. Number 2, entries in the financial statement, entries in the books of accounts should have proper evidence. Number 3, there should not be any omissions or fictitious entries. Number 4, information conveyed should be clear and unambiguous. Number 5, the financial statement should be prepared as per accounting standards. Number 6, finally, financial statements are giving true and fair view or not. So these are the points to be considered before expression of an opinion. Now let us try to proceed further with remaining concepts from this first chapter. So the next chapter, and in fact, whatever we are going to discuss in this chapter, nature, objective and scope of audit, the entire source for this chapter, nature, objective and scope of audit, is two standards actually, SA 200 and SA 210. So SA 200 is the standard which from which majority of the chapter has been taken. At the end of this chapter, there will be a few questions regarding engagement letter, etc. Those are actually taken from SA 210. So when I say I am teaching you the chapter nature, objective and scope of audit, in fact I am trying to teach you these two chapters, these two standards, SA 200 and SA 210. So now let us try to proceed further with remaining questions. So second question, if you observe here, what are the objectives of auditor as per SA 200? SA 200, the first and foremost standard on audit, whose title is Overall Objectives of an Independent Auditor and Conduct of an Audit in Accordance with the Standards on Audit. So SA 200, the first and foremost standard, like AS1 is the first and foremost standard in accounts, SA 200 is the first and foremost standard in audit. And that particular standard's title is what? Overall objectives of the independent auditor and conduct of the audit in accordance with standards on audit. Now this standard has given some objectives to the auditor. What are they? Which we already know. The auditor has to obtain reasonable assurance about whether financial statements are free from material misstatements and whether financial statements are prepared as per applicable financial reporting framework. This point we have already revised in the introduction. So two objectives, auditor need to express an opinion whether financial statements are free from material misstatements and whether financial statements are prepared as per applicable financial reporting framework. But they use the term here reasonable assurance. We will talk more about this term reasonable assurance when we are revising the concept inherent limitations. Just remember, SA 200 is asking you to obtain reasonable assurance, but what exactly is reasonable assurance? We will try to understand it in a short while. Clear? And also one more objective is there as per this SA 200. So one more objective is to report on the financial statements and communicate as required by the essays in accordance with the auditor's findings. Finally, whatever your findings are there after completion of audit, all that findings are required to be reported, and those findings are required to be reported as per the respective standards on audit. So first you need to express opinion. After that, in your opinion, in your audit, whatever your findings are there, all those findings are required to be reported as per the relevant standards on audit. So this is what question number 2 is here. Now coming to the third point, now first we will go to fourth question, which is regarding what are the principal aspects to be covered in the audit. Sometimes they will ask a question like this, what are the main aspects or what are the principal aspects which are required to be covered in the audit. So let us try to have a quick revision. What are that principal aspects which are required to be covered in an audit? First thing, we need to cover accounting and internal control system. First main aspect which we have to cover in our audit is verify the client's accounting and internal control system. Sir, what is this accounting system? Very simple, whatever software, policies, procedures which the client is following for maintaining books of accounts, we call it as accounting system. If your client is using the software called Tally for the purpose of maintaining books of accounts, Tally is an accounting system. Similarly, what is internal control system? Internal control system means any policy or procedure which is designed by management to prevent the mistakes from happening in the organization. What do you mean by internal control? Those policies and procedures which are implemented by the management to prevent a mistake from happening in the organization, that we call it as what? Internal control. Like for example, the management has installed the CCTV camera and covering the entire premises of the organization. Installation of that CCTV camera is a internal control. The management has put a policy that before any employee can enter inside the company, they have to show their identity card and also give access to their biometric. Then only the gate will open. Policy followed by the management, internal control. And the management has put a policy that security guard will be appointed at each and every entry and exit point, internal control. So like that, any policy or procedure which is designed, implemented or maintained by the management to prevent mistakes from happening in the organization, we call it as internal control system. So accounting system means simply the software policy which they follow for maintaining books of accounts. Internal control means any policy or procedure which the management is following for preventing mistakes in the organization. And one of the main aspect which I as an auditor required to cover is I need to first examine their accounting system and internal control system to know whether they are appropriate with the business. One of the main aspect which I have to cover, first I should try to understand what accounting system my client is following, what internal control systems my client is following, whether they help the organization in recording of all the transactions or not. First I need to study the client's accounting system as well as internal control system. And whatever accounting and internal control system which I have examined, that I need to review, I need to verify in an in-depth manner to find out whether this accounting and internal control systems are having any material inadequacies and weaknesses. Whether these internal control systems and accounting systems, are they suffering from any weaknesses which is creating an opportunity to fraud or which is creating an opportunity for having a fraud or error. Very simple points, guys. First main aspect, accounting and internal controls. I need to check whether my client is having proper accounting and internal control system. Now I need to study that accounting and internal control system in a much more in-depth manner to find out whether these internal controls are suffering from any weaknesses which create an opportunity for fraud or error to happen. And next one, I need to check arithmetical accuracy. What do you mean by arithmetical accuracy? Mathematical calculation, addition, deletion, closing balances calculation, balance sheet tallying, profit calculation. So as we all know, accounts involve math, not the advanced math like algebra, etc. We have basic math in the accounts like additions, deletions, and the most complex math calculation in the accounts is division. That's all, nothing else. So I need to check whether all the calculations are done correctly in the books of accounts. That is, I need to check the arithmetical accuracy. But I don't feel this point is still relevant today. Why? Because today all the basic math is handled by the accounting software, so we can rely on the softwares on today's environment. But whatever it is, one of the main aspect which has to be covered in the audit is checking of arithmetical accuracy. Then the next main aspect which needs to be covered in an audit is, the next main aspect which needs to be covered in an audit, verifying authenticity and validity, genuinity and validity of the transactions. Sir, how to verify genuinity and validity, sir? Simply by checking the supporting documents. This is also one of the main aspect. Find out whether the transactions are valid or not by checking the genuinity with the help of supporting documents. And also, I need to mainly check whether there is a proper distinction made between capital and revenue expenses. Whether the management has made proper classification between revenue expenses and capital expenses. And also, whatever entries which are recorded, whether they belong to current year, none of the previous year's income or expense should be recorded in the current year. None of the future year's incomes and expenses should be recorded in current year. I need to check that also. Then I need to compare balance sheet and P&L and whether they are matching with the books of accounts or not. Nothing but same point as we have seen in question number 1, whether financial statements are matching with books of accounts or not, that I need to check here. That is also one of the main aspect. After that, I need to verify items of the financial statements, like I need to verify with it when respect to assets, whether the assets are existing or not, whether the assets are completely recorded or not, the value at which the assets are shown are correct or not. I need to verify the assets. Similarly, I need to verify the liabilities. Not just liabilities, I need to verify the items of P&L also. So that's why I have given one broad heading: verification of items of financial statements, verification of assets, verification of liabilities, verification of incomes and expenses. Another main aspect. Next point, in case if you are conducting audit of a statutory entity like company or corporate entity like company, LLP, etc. In addition to above all points, even I need to check the statutory compliances also. Whether the entities, whether my client entity is complying with respective laws and regulations which are applicable for them, that also I need to check. And last point, if you observe, reporting. After completion of the entire audit, whatever your findings are there, that findings you should not keep it to yourself. That findings should be reported. How to report it, sir? By expressing your opinion in a written document. That written document which contains the auditor's opinion only, we call it as what? Audit report. So these are the main aspects which are required to be covered in the audit. What are they? Number 1, we need to verify accounting and internal control related points, arithmetical accuracy, checking the validity and the genuinity of the transactions. Number 3, we need to check whether there is proper classification made between capital versus revenue, whether incomes and expenses belongs to current year, verifications of items of the financial statements, statutory compliances, and finally reporting. So these are the main aspects which are required to be covered in an audit. Now let us come to remaining questions. We'll talk now about question number 3. So what is that question number 3 about? Let us have a quick revision. So question number 3, write a short note on scope of audit. Or even they might alternatively ask you a question, what and all factors you have to keep in mind while deciding the scope of audit. Nothing but as an audit, what will be included in your scope, what you are supposed to do, what you are not supposed to do. If you ask me, the points which we will see in this answer are not something new. It is actually a combination of few points which we have read in the question number 1 and a combination of few points which we have read just now in the principal aspects to be covered in an audit. So let us try to revise it, what they are trying to say here. As an auditor, when you are conducting audit, you should cover all aspects of the organization which are related to financial statements. When I say you are supposed to verify financial information, it is not just that the management will give you a copy of financial statements, the management will give you a copy of books of accounts. You have to verify only that pieces of paper which are given to you. No. All the enterprise, all the parts of the organization, all the aspects of the organization which are related to financial statements, auditor should cover all. Like for example, if you are able to see the amount of closing stock of 10 crore rupees in the balance sheet, you will have the responsibility to even go to the warehouse and check whether really in the warehouse the 10 crores worth of stock is there or not. So like this, an auditor should cover all aspects of the organization which are related to financial statements. Number two, as a part of your scope, you need to check whether the financial information is reliable or not. Whatever financial information is there, which is there in the financial statements, is it reliable? Is it trustworthy? Is it trustable? Now, how can I find out, sir? By checking the underlying source data. So nothing but by checking the books of accounts. So sir, how can I find out whether the entries in the books of accounts are reliable or not? Very simple. Once again, study the accounting systems and internal controls. That's what we have read in the principal aspects. First point, no, just that is getting repeated. So as a part of your scope, you need to check financial information is reliable or not. How you will come to know financial information is reliable or not? By studying accounting system and internal control system. Similarly, we need to carry out other testing methods, inquiries like inspection, observation, recalculation, reperformance. So many other techniques will be there, which we will cover as a part of subsequent chapters. So we need to even carry out that other techniques and verification procedures to find out whether the financial information is reliable. Next, I need to check whether there are proper disclosures given in the financial statements. Nothing but, if I put it in common language, whether financial statements are prepared and presented as per applicable financial reporting framework or not, I need to check. This point we already know. Now the question is, how I will come to know whether financial statements are prepared as per applicable financial reporting framework or not. Just see what they are saying, comparing the financial statements with underlying books of accounts. Once again, repetition, whether the financial statements are matching with the books of accounts or not. See, this point has been repeated in question number 1, principal aspects question, even in the scope of the audit. And even I need to check whatever assumptions, whatever judgments which my client has made, whether they are reasonable or not. So as we all know, management will prepare financial statements after making assumptions about so many items. As an auditor, I need to check whatever assumptions and estimates which my client's management has made in the preparation of financial statements, whether they are reasonable or not. And even I need to check whether the accounting policies are properly applied or not. So by checking these three things, I will come to know whether the financial informations are presented and prepared as per applicable financial reporting framework. Sometimes what will happen is the client might come to you and ask you to perform some duties which are beyond your scope. Like for example, you are appointed as auditor of some company. Now one particular client, that client is approaching you and asking you, sir, we have appointed you as an auditor. No, there is a case pending in the court of law. You fight the case on behalf of us. Are you supposed to do? Is fighting the case part of your scope? Are you competent to do it? No. As an auditor, what is our scope? Verify the financial information. If the client is asking you to do something which is beyond your scope and competence, auditor can simply reject it on the face. Or similarly, if the client is coming and asking you, hey auditor, we have appointed you as an auditor, please come and do the repair of the machinery. Are you supposed to do it? That is beyond your scope. That is beyond your scope and capability. So you are not supposed to perform those activities even if the client is requesting, which are beyond your scope and competence. You are straight away reject it on the face. And finally, in case if the management is putting a restriction on the scope, constraint on the scope, sir, what if the management is restricting me from not doing the audit? So they're not giving me access to the books. They're not letting me verify some aspect of the organization related to financial statements. Management is not giving me whatever information I'm asking. So like that, in some cases, what could be possible is the management might put a restriction on the scope of your work. They will not let you do the work properly. In that case, the standard has told one simple thing: if there is any restriction on the scope, the auditor can mention the same in the auditor's report. What auditor can do? You can mention the same in the auditor's report. Whatever restrictions that you have faced while doing the audit, without any hesitation, mention everything in the audit report. The management restricted me on these matters. So these are the aspects which are required to be considered while deciding the scope of audit. So what are the aspects which are required to be considered while deciding the scope of audit? We should cover all aspects of the organization related to financial statements. We should check the reliability of underlying information or financial information. We need to check whether financial statements are properly prepared and presented as per applicable financial reporting framework. If they are asking us to perform some duties which are beyond our scope and competence, straight away reject it on the face. And if there is any restriction on the scope put by the management on your work, mention the same in the auditor's report. So this is what question number 4 is about. But anyhow, question number 5 we have already completed, which is regarding different types of audit on the basis of requirements of law. Question number 6 also I have covered what are the various advantages. Now we will try to understand remaining concepts regarding this particular chapter. So first we will talk about qualities of an auditor. So if you want to become a good auditor, what kind of qualities you need to possess? So as per the standards, in order to become a good auditor, we need to have two kinds of qualities. One is professional or technical qualities and the other one is personal qualities. Professional or technical qualities are nothing but the list of our subjects. So if you want to become a good auditor, you need to have very good knowledge of accounting, you need to have very good knowledge of auditing, you need to have good knowledge of laws, general laws and also specific laws. You need to have very good knowledge of taxation related laws. You need to have knowledge of general management, computer and information systems, nothing but economic related matters. So if they ask you what are professional or technical qualities, without any second thought, just write the list of all the subjects which you are reading as a part of CA Inter. So professional qualities or technical qualities are nothing but the subjects over which we need to have good knowledge. Then just having professional qualities alone will not be enough. Even auditor need to have good personal qualities also. Like what kind of personal qualities, sir? When I say personal, when I give examples, like auditor should be a cautious person, he should be a careful person, he should have he should be doing the audit with utmost care. So let me show you that particular question, qualities of an auditor. Yeah. So personal qualities like tact, you should be an intelligent person. Caution, you should be a careful person. You should be having firmness, strong enough, not physically strong. You have to be professionally, knowledge wise and decision wise. You should be strong. Good temper you should have. You should maintain good temper towards the client. Integrity, you should be honest person. You should have decision making capability, and even you should have relevant experience of the industry. You should have good understanding of the industry. Judgment, good decision making capability should be there. Hell, a lot of patience is required. Clear headedness, clarity of thought is required. You should have a person, you should be a reliable person. The client should come and trust you. Such a reliable person you should be. So in order to become a good auditor, you should have all those good qualities which a good person will have. Whatever qualities that make a good person, all those qualities will be required to make a good auditor. So in order to become a good auditor, you need to have both personal qualities as well as professional qualities. Both should go hand in hand. So this is what regarding qualities of an auditor. Now talking about the next important concept, there are some ethical requirements which every auditor must comply with. In order to be called as a good auditor, the auditor should have some ethical requirements. And in fact, there are 5 ethical requirements which auditor must comply with. Number 1, integrity. Number 2, objectivity. Number 3, confidentiality. Number 4, professional competence and due care. And the last one, professional behavior. So these are the 5 ethical requirements which every auditor must comply with. Name them once, everybody. What are the 5 ethical requirements? Integrity, objectivity, confidentiality, professional competence and due care, and professional behavior. So let us try to understand what does each of this ethical requirement mean. Number 1, integrity. Integrity means auditor should be a honest person, sincere person, straightforward person. He should not associate himself with any document which he believes to be false. On one hand, you are believing that information is false. How can you sign and let the others believe that information? You can't do it. So being an auditor, you should be a honest person. Don't associate yourself with any other document which you believe that contains a false or misleading information. Number 2, objectivity. Objectivity means unbiasedness, impartiality. You should not show bias towards any clients. You should be fair enough while making decision. Confidentiality. Being an auditor, we enjoy a privilege. We get all the information from the client. Client will not say why I should provide this information to you, to the auditor. This question will not be raised by the client. So being an auditor, we are enjoying such a privilege, and that privilege comes with responsibility also. Whatever information that we are getting it from the client, that information should be kept confidential. You should not go and distribute it to everybody. So sometimes while doing audit, we might get access to price sensitive or confidential information of the client. That information should be kept secretive. That should not be disclosed. Fourth ethical requirement, professional competence and due care. Nothing but our profession deals with such subjects which requires continuous updation. Every year, finance minister comes and conducts a meeting on February 1st. Budget will come, tax laws undergo changes. Once in a while, GST council will meet, they will release a circular, indirect taxes laws will undergo changes. Sometimes laws will be scrapped altogether, a new law will be introduced. Like Companies Act 1956 was scrapped and Companies Act 2013 was introduced. All the earlier indirect tax laws were scrapped and new indirect tax law, GST, has been introduced. So being an auditor, we deal with such as subjects which undergo continuous changes. Being an auditor, it is our responsibility to keep ourselves updated with all the changes which are happening in our subjects. That is what the meaning of professional competence. We have to make ourselves competent by updating our knowledge on all the updates happening in our professional areas. And also we should have due care or diligence also, you can say. That means we have to do the audit with utmost care. We should not be negligible while doing the audit. Then last one, professional behavior. Whatever work we are doing, that work should be as per laws and regulations, and we should not do anything which brings a discredit to the profession. We should not do any such task which brings a bad name to the profession. So these are the 5 ethical requirements which every auditor must comply with. What are they? Integrity, objectivity, confidentiality, professional competence and due care, and professional behavior. These are 5 ethical requirements. Now we will try to understand few more concepts relating to relating to independence. So independence is something which I have explained at the time when I am revising the definition of audit. So I told audit is an independent examination. So what is the meaning of the term independence? Like as I've already explained, the term independence means the auditor should be able to take decisions without any influence from others. So that's how the term independence has been defined. The judgment of a person should not be subordinate. The judgment of a person should not be changed. The decision of a person shall not be changed according to the wishes or directions of another person, especially who have engaged him. So at the time I am an auditor, if I am taking decision, I should take the decision without getting influenced by my wishes, without getting influenced by directions and wishes of the management who have appointed me. So if I think something is wrong, I should say it, yes, this is wrong. Before giving that negative opinion, I should not think what my client what will happen to my client if I give a negative opinion. The moment that thought comes to your mind, independence has gone to hell already. So like this, as an auditor, you should have such an important quality or characteristic, independence, which means your decision should not be changed according to the wishes and directions of another person, especially those who have appointed you. And whenever I say independence, there will be 2 aspects related to independence. Or I can say it as independence will be of 2 types. Independence of mind, and the other one is independence of appearance. Independence of mind, and the other one is what? Independence of appearance. So independence of mind means it is a state of mind which makes a person to take the decision without any bias. Independence of mind means what? Mind means what? It is a state of mind. It is an agreement of mind. If I agree in my mind to act independently, if I am making a decision in my mind, I am doing audit of this client, I will not show any kind of bias. I will not change my decision according to other person's wishes. Whatever I feel it as correct, that only I will say. So if I made a state of mind, if I made an agreement of my mind to act independently, that we call it as independence of mind. Whereas independence of appearance means I should be not related to any of my clients. Like for example, if I am conducting audit of a client, audit of a company in which my father is a director, I am not appearing to be independent here. What is causing me to compromise on the independence? I am having one close relationship with the client for whom I am doing the audit. So not having any kind of close relationship with the client for which you are doing, that we call it as independence of appearance. So independence of mind means it is a state of mind. If I agree in my mind, for example, I am doing audit of the client X Limited. In this client, my father is a CEO. My father is a CEO. I am conducting audit of this client X Limited. Before going to the audit, I agreed in my mind, I will independently do the audit. I will not show any kind of bias. Okay, independence of mind is there, but you are not independent of appearance here. Why you are not independent of appearance? Why? Because it is clearly visible. You are not appearing to be independent. You are not looking as independent. Why you are not looking as independent? Why? Because you have a relationship with the client. No, your father is a CEO of the company where you are looking as independent. So you are not appearing to be independent. You are not visible as independent. Understood? So independence will be of 2 types. One is independence of mind and the other one is independence of appearance. Independence of mind means it is agreement of mind to act independently. Independence of appearance means not having any kind of relationship with the client which will make your independence getting compromised. So like this, independence will be of 2 types. And there are some safeguards to independence. Sir, how to protect my independence? So what the standard will simply try to say is, before accepting the audit only, check whether you will be able to do the audit independently or not. Before you say yes to the audit assignment, before accepting the audit only, you have to make an assessment. If I accept this particular client's audit, am I in a position to do the audit independently, or is there a possibility of compromising independence? If you feel that yes, I can act independently, then only accept the audit. If you feel that there is some threat to independence, there is some danger to the independence, there is a possibility of compromising on the independence, then don't accept the audit only. I'm talking about before accepting the audit. So before accepting the audit, check whether you can do the audit independently. If in case if you find any threat to independence, check whether you can remove it. If you are not able to remove that threat to independence before accepting the audit only, you know that don't accept the audit at all. Now, sometimes what will happen is after I have accepted the audit, then I will come across some threat to independence. Then what I should do? At the time of accepting, no threat to independence, but after accepting the audit, sometimes I might face some threat to my independence, danger to my independence. Then what the standard is, then what the standard tries to say is, if after accepting the audit, if you are facing any threat to independence, there also, if possible, try to eliminate it, try to remove that threat. If you are not able to remove that threat, withdraw from the audit. What the standard is suggesting, altogether resign from the audit. No longer you are permitted to continue the audit. So like this, there are some general safeguards which an auditor needs to follow to protect his independence. Before accepting the audit only, check whether you have any danger. If yes, remove that danger. If you are unable to remove that danger to independence, eliminate from, don't accept the audit only. After accepting the audit, then if any threat arises, if possible, try to remove it. If you are unable to remove it, then withdraw from the audit. Clear? So these are the safeguards to independence. Now I have one more point to explain, which is threats to independence. Which is what? Threats to independence. So there are some threats to independence. When I say threat to independence, which means there are some events or circumstances which have a possibility of auditors' independence getting compromised, which has a danger of auditors' independence to get reduced. So what are that threats to independence? Let us try to understand them. So IFAC, there is an international federation called IFAC. That IFAC has identified 5 kinds of threat to independence. How many threats they have identified? 5 threats. Who identified? IFAC, International Federation for Accountants, has identified 5 threats to independence, which are, as you could see here, self-interest threats. Then you will have self-review threats. After that, advocacy threats, familiarity threats, and intimidation threats. So let us try to understand what are these 5 threats and when do they occur. First, talking about self-interest threat. Self-interest threats occur when the auditor is getting benefited from some financial interest in the company. Self-interest threats occur when the auditor is getting from financial interest in the company. Like examples are, you are having shares in the company, or you have taken some loan from the company, or you are exclusively dependent on client's fees. You are not having any other client, you are exclusively dependent on client's fees, or you have close business relationship with the client, or you are expecting a potential employment with the client. That means the client is offering you, I will make you CFO next year, or your client told, I will tell the fees after completion of audit, contingent fees for the audit engagement. That means your client is saying, sir, you do the audit, I will decide the audit fees after completion of the audit. That means he is indirectly coming with a favor that, sir, if you give me a positive opinion, I will give you more fees. If you give me unfavorable opinion, I will give you less fees. So like this, if the auditor is having benefited from some financial interest in the company, then which kind of threats occur? Self-interest threats occur. See, the most example thing in this particular answer is you have to remember this example. Which example will fall under which threat? This is most important. They might ask you in the form of case scenario based MCQs, or even they might ask you in the form of true or false statements. So please thoroughly go through the examples of all the threats to independence. Very important. I do expect in this attempt they might definitely ask a question, either a true or false statements, or in the case scenario based MCQs regarding this threats to independence. They will give an example and find out which kind of threat it is. Clear? So this is what self-interest threat, when auditor is getting benefited from some financial interest in the client for which he is doing the audit. Then we have next one, self-review threat. Sir, what is a self-review threat? So the name itself says the auditor is reviewing his own work which he has performed as a part of previous assignment. What do you mean by self-review threat? The auditor is reviewing his own work which he has done as a part of previous assignment. You are reviewing your own work. Like for example, you provided the services of accounting and bookkeeping services for the client, and you prepared financial statements for them. After that, if the same client is asking you to do the audit, That is a self-review threat. Why? Because being an auditor, you have to verify financial statements and books of accounts which are prepared by yourself. Self-review threat. Or you have been the director of the company for some while, and once you resign from the director, the company is appointing you as an auditor. So here also self-review threat. How come? Why? Because if you are a director in the company, you would have already associated in the preparation of financial statements. Now, if we are appointed you as an auditor, you are supposed to verify the same financial statements which you have verified. Understood? So this we call it as self-review threats, when auditor is reviewing his own work without which he has performed as a part of his previous assignments. The third one comes advocacy threat, and when this advocacy threats occur is when the auditor promotes the client's opinion without any reasonable basis. When the advocacy threat occur, when the auditor is supporting the client's opinion without any reasonable basis. See, this will mainly happen in the case of when the auditor is acting as a client's advocate for income tax related cases, etc. For example, if a company appointed auditor to fight the income tax case for them. So when auditor is appointed as an advocate, his objective will be to support the client. Advocates know that their clients will do the mistake, but still they will try to support the client. So a company has appointed an auditor, a chartered accountant, to fight the case for them before income tax department. Now, being an advocate, he has to support the client's opinion. Even after knowing your client has done a mistake, still you will try to support the client. If the same chartered accountant is appointed as an auditor, what will happen is you have to find the mistake. You have to report the mistake. So you are holding two contradictory positions. Acting as an advocate, you are supporting the client's mistake. Acting as an auditor, you have to report the mistakes. At one place, you have to say your client is correct. At another place, you have to say the client is wrong. So exactly two contradictory positions. So this is called as advocacy threats. Somewhere independence will get compromised. So advocacy threats occur when the auditor promotes the client's opinion without any reasonable basis. Then finally, familiarity threat. The familiarity threat, the name itself says these kind of threats occur when the auditor is having some close personal relationship with the client. When the familiarity threat occurs, when the auditor is having some close relationship with the client with whom for which he is doing the audit, like the auditor is having some close relative who is in the top level management of the company, or you are acting as an auditor for significant amount of time, for last 20-30 years you are continuously acting as an auditor of a company, or even you are accepting significant gifts and hospitality from the client. So here also examples are very important. So please make sure that you are going through the examples. Understood? So one conclusion is familiarity threat occurs when the auditor is having some close association or relationship with the client which is auditing. And then finally we have intimidation threat. Intimidation threat, as the name itself says, auditor wants to act independently, but he is being threatened from acting independently by way of blackmailing, by way of threatening, by bringing a pressure on him to reduce the audit fees, or giving some blackmail threats. So the auditor wants to act independently, but he is prevented by the client from acting independently by way of threatening, blackmailing, etc. That we call it as intimidation threat. So these are the 5 threats to independence which are identified by whom? Which are identified by IFAC, called full form is International Federation for Accountants. What are the 5 threats which are identified? Self-interest, self-review, advocacy, familiarity, and intimidation threats. Clear? So this is what the concept of independence. We understood meaning, types of independence, and even we understood safeguards to independence. At the same time, we have even understood what are the threats to independence. Clear everybody till here? Now we will try to revise the most important concept from this particular chapter, which is inherent limitations of audit. Very important concept from the examination perspective. So let us try to revise what is this inherent limitation and what are those inherent limitations. First of all, the meaning of the term inherent limitation. So they say that the process of auditing is suffering from some drawbacks or limitations which are of such a nature that no matter whatever you do, you cannot avoid them. The process of auditing is suffering from some limitations which are of such a nature that too unavoidable. Those limitations are of such a nature that no matter whatever you do, those limitations cannot be avoided. So the process of auditing is suffering from some limitations which are unavoidable in nature, and those limitations we call it as inherent limitations. The process of auditing is suffering from some limitations which are of such a nature which are unavoidable in nature. Those limitations we call them as inherent limitations. And because of these inherent limitations, there are some consequences. Because of this inherent limitations, there are some consequences. Number one, because of this inherent limitations, the auditor can only obtain reasonable assurance but not absolute assurance. Because of this inherent limitations, we can expect auditor to only obtain reasonable assurance but not absolute assurance. Now, what is the meaning of reasonable assurance, sir? The term reasonable assurance has been defined something like this. Reasonable assurance is a high level of assurance but not absolute assurance. How the term reasonable assurance is defined? It is a high level of assurance but not absolute assurance. Now, first we need to understand what is absolute assurance. Absolute assurance means giving 100% guarantee. And the standards are saying that as an auditor, you can get high level of assurance, you can get high level of confidence, but auditor can never ever get absolute assurance. Auditor can never ever give guarantee. So because of inherent limitations, auditor can only obtain reasonable assurance. Auditor can obtain only high level of assurance, but he can never ever obtain absolute assurance. That's why from the beginning I was always saying auditor can only express opinion, but I never said auditor will give a guarantee. So why auditor we can't give guarantee, sir? Why auditor can't obtain absolute assurance, sir? Why? Because there are some limitations. These are these inherent limitations which will make the auditor's opinion can go wrong. Understood? So because of these inherent limitations, there is a possibility that auditor's opinion can go wrong in the future. That possibility will always be there. No matter how effectively you do the audit, no matter how sincerely you do the audit, no matter how much effort you put from the auditor's side, still there will always be a chance of auditor's opinion going wrong because of inherent limitation. So that's why we always say auditor can only obtain reasonable assurance but cannot obtain absolute assurance. Sir, why auditor cannot obtain absolute assurance, sir? Why? Because it is suffering from some inherent limitations. Not just that, there are even other implications also. Like as I was telling always, auditor can only give opinion but not guarantee. Sir, why auditor can give only opinion? Why not guarantee, sir? Once again, the reason is inherent limitations. Number three, because of inherent limitations, there is always a auditor's opinion can go wrong in the future. So because of inherent limitations, no matter how effectively you do the audit, still there will always be a chance for auditor's opinion going wrong. And also there is always audit risk associated with the auditor. Audit risk cannot be eliminated or audit risk cannot be reduced to zero. So audit risk means nothing but risk of auditor's opinion going wrong. And I am telling, because of inherent limitations, there is always a possibility of auditor's opinion going wrong. When I say there will always be a possibility of auditor's opinion going wrong, that means there will always be a audit risk no matter whatever you do. So audit risk cannot be eliminated or audit risk cannot be reduced to zero. So these are four implications of inherent limitations, or because of these inherent limitations, this is what the impact will be there on the audit. So what are the four implications of inherent limitations? Everybody repeat. Auditor can only obtain reasonable assurance but not absolute assurance. Auditor can express only opinion but not guarantee. There is always a possibility of auditor's opinion going wrong. Audit risk can never be eliminated. Audit risk can never be reduced to zero. There will always be a audit risk. What is the single reason for all these four consequences? The single reason is the process of auditing is suffering from some limitations which are of what nature? Avoidable or unavoidable? Which are of unavoidable in nature. Because of this, these many consequences will be there. So we understood what are the consequences of inherent limitations, but what are inherent limitations? What are inherent limitations of audit? So inherent limitations are of four types. Let us try to understand what are that four categories of inherent limitations. Four types of inherent limitations are there. So which we have given it here in question number 7. Let us try to have a look at it. So what are inherent limitations? Number 1, as you could see here, nature of financial reporting. Number 2, the second inherent limitation, which is nature of audit procedure. Third one, timeliness of financial reporting and balance between benefit and cost. And then finally we'll have one more thing, which is other matters or other limitations also, you can say. So let us try to understand what is this each category of inherent limitation. First, we will start with nature of financial reporting, which means that financial reporting means the process of preparation and presentation of financial statements. And the first limitation, what they are saying is the process of preparation of financial statements itself suffers from some limitations. The process of preparation of financial statements itself suffers from some limitation. Now, what is that limitation? So the limitation is the management while preparing financial statements, there will be various items of the financial statements where management cannot measure everything with accuracy. Some items involve making of assumptions and estimates by the management. There will be various items of the financial statements where management cannot exactly calculate the amounts. They need to do some assumptions and estimates. Like if you take depreciation calculation involves a lot of assumptions and estimates. Like useful life, residual value, all these are assumptions. Provision for bad and doubtful debts, once again assumptions and estimate. So like this, the management while preparing financial statements in different areas, they are required to make assumptions and estimates. And whenever I am saying that I will use assumption and estimate, there is always a there will always be a possibility for that estimate going wrong or not. What do you mean by estimate? When you don't know something with accuracy, then we use estimate, no? And when I say I'm using estimate, that estimate will always have a possibility of going wrong or not. Similarly, the management will make assumptions and estimates while preparing financial statements, and these assumptions can go wrong in the future. And when these assumptions go wrong in the future, financial statements also go wrong. And when the financial statements go wrong in the future, auditor's opinion also will go wrong. Like for example, in year 1, the company has bought some plant and machinery. They made an assumption that that plant and machinery will work for 10 years. But in the second year, what happened is because of short circuit, that entire plant and machinery got burnt. So management calculated the depreciation, estimating useful life as 10 years. This is what the estimate they have made, but actual life turned out to be 2 years only. Now, your assumption has gone wrong. If your assumption has gone wrong, financial statements also will go wrong. No. If that financial statements has gone wrong, the opinion given by the auditor on that financial statements also will be wrong. But is it mistake of auditor? No, it is not a mistake of auditor. This limitation is there with the financial reporting process itself. What is that limitation? Usage of assumptions and estimates. Can this limitation be removed? Removing this limitation means what? Preparing the financial statements without using even a single assumption or estimate. Can you do that? No, we can't do it. We can't do it. So the process of auditing is suffering from some limitation, which is nature of financial reporting, which means the financial statement preparation process itself is suffering from some limitation, which is usage of assumptions and estimates. And these assumptions and estimates can go wrong in the future. And when these assumptions and estimates go wrong in the future, obviously financial statements also will go wrong, which can make auditor's opinion also can go wrong. Clear? So that is the first inherent limitation, nature of financial reporting. Now talking about second inherent limitation, which they are saying the nature of audit procedures. What is the second inherent limitation? Audit procedures. Now audit procedures are also suffering from some limitation. The procedures which will be performed by the auditor, they are also suffering from some limitation. What is that limitation is? Because of some practical constraints or because of some legal limitations, the auditor might not be in a position to obtain audit evidence. Either because of practical limitations or because of legal limitations, sometimes auditor might not be able to get the evidence. And if you are expressing the opinion without obtaining the evidence, then obviously there is a chance of your opinion going wrong. No. So that is what the limitation associated with nature of audit procedures. Because of some practical limitations or because of some legal limitations, auditor will not get all the evidence required. Like some examples of the circumstances also they are telling, because of which auditor might not be able to obtain evidence. Number one, management themselves may not provide the information, either intentionally or unintentionally. You go to the management and ask them some information. Management themselves might not provide the complete information to you. And if the management themselves are not providing complete information, then obviously you are expressing the opinion on insufficient evidence and your opinion can go wrong. And sometimes, no matter how effectively you perform audit procedures, frauds will be carried out in a very sophisticated and careful manner that fraud, no matter how effectively you perform audit procedures, you might not be able to find it out. So sometimes fraud may involve sophisticated and carefully organized schemes which are designed to hide it. So whatever audit procedures which you perform to gather audit evidence, those normal audit procedures might not be able to gather audit evidence regarding frauds which are sophisticatedly and very carefully carried out. Like PNB scam happening from past few years. Don't you think auditors were able to find it out? Might not be. Why? Because the fraud might be carried out in a sophisticated manner. They have carried out in a very careful manner. So even auditor, after putting all their efforts also, they are not able to find it out. So like this, sometimes frauds will be carried out in a very sophisticated and carefully organized manner. No matter how effectively you perform audit procedures, you might not be able to identify those kind of carefully organized scams and frauds. And then finally, audit is not like an investigation, official investigation. So you might have heard about official investigations, like income tax raid will happen, where their officers, government officers will come with lot of supreme powers. They will come and break somebody's wall. They will come and break somebody's premises to find out the black money. Do you think auditor also will have all that powers? If you are conducting audit of some company, can you break the walls of the client? Can you break the ceilings of the client? Can you cut the communication, stop the movement of the client? No. Then what client will do? Then what client will do if you do these kind of things? He will hold you by the collar and throw you out of the company. So being an auditor, our audit is not like investigation. So whatever powers that are available for official investigators, those powers will not be available to the auditor. Since we don't have such extreme super powers, so we can't obtain all the evidence required. So the process of auditing procedures itself is also suffering from some limitations. Because of practical and legal limitations, we can't obtain audit evidence. And if we don't obtain audit evidence, then our opinion can go wrong. And 3 examples they have given regarding that limitation. Sometimes management will not provide you with the information. Sometimes fraud will be carried out in a sophisticated and carefully organized manner. And audit is different from investigation, so some powers might not be available for us. Then talking about the third inherent limitation, time and cost benefit comparison. See, as we all know, audit has to be completed within a reasonable time and cost. You will not be given enough of time. You will not be given 2-3 years of time to complete the audit. You will not be given thousands of crores of money for doing audit. So audit always has to be completed within reasonable time and reasonable cost. See, if audit has to be completed within reasonable time and cost, can we do 100% verification of the client? No. Assume Reliance Industries Limited. If you want to do 100% verification of Reliance Industries Limited, it will take 2-3 years of time. But auditor will not be given that much amount of time. Audit report has to be given within reasonable time and within reasonable cost. If auditor has to complete the audit within that reasonable time and cost, there is no other option. Auditor has to verify the transactions on sampling basis. Obviously, no. That's why we follow sampling in the audit. But if you follow the sampling basis, there is a risk there. What is the risk by following sampling? Sampling means what? Out of 100% of the transaction, you verify only one small sample taken. Now, if out of 10,000 transactions, assume you have taken a sample of 1,000 transactions. If you verify 1,000 transactions, you are indirectly saying that you did not verify 9,000 transactions. In that 9,000 transactions which you did not verify, there might be a fraud also, there might be an error also. So, because audit has to be completed within reasonable time and cost, we have to verify the transactions on sampling basis. And if we verify the transactions on sampling basis, there is always a possibility of not finding out frauds and errors. Clear, everybody? So this is also one inherent limitation. But here there is one important statement, very, very important for true or false statements. The matter of difficulty, time or cost involved is not in itself a valid basis to omit an audit procedure for which there is no alternative. That means you can't simply use time and cost as a reason for altogether omitting audit procedure. You are not performing any audit procedure. And when someone is asking you, boss, why you did not audit procedure, why you did not perform audit procedure, can the auditor escape saying, I did not have enough of time, I did not have enough of cost, so that's why I did not perform audit procedure, that's why altogether I omitted audit procedure? Can the auditor use time and cost as a reason for altogether omitting audit procedures? No. See, time and cost constraint will save you only from not obtaining absolute assurance. Time and cost constraint will not save you from not even obtaining reasonable assurance. Within the limited time, within the limited cost, it is your responsibility to obtain reasonable assurance. If you do not get guarantee because of time and cost constraint, okay, law will spare you. But if you do not get reasonable assurance also within the limited time and cost, then law is not going to spare you. This sentence is very important. They can play with you like anything in the examination. So what they will ask you is, the matter of difficulty, time or cost involved is in itself a valid basis for the auditor to omit an audit procedure. Do you agree with that? No, it is not in itself. Sometimes what they will do is, entire sentence they will give as it is, but they will remove this word no. When there is alternative, they will say. But no, the sentence will make sense only when the term is when there is no alternative. So like this, they can play with you in the examination like anything. So please be careful about this particular sentence. They might twist the question in multiple ways. Sometimes they will remove not here. Sometimes they will remove no here. So sometimes they will say not to omit the audit procedure. So like that, they can play with you. Please be careful. These kind of sentences, you try to get the conceptual clarity. You try to read it twice or thrice and get hold of the concept there. Clear? This is the third inherent limitation. Now let us come to the last category of inherent limitations, which is other limitations. So first they have given three broad categories: nature of financial reporting, nature of audit procedures, time and cost constraint. Now there are some other limitations also which doesn't fall under above three categories. And the thing here is, in these other limitations, the severity of the limitations is even higher. In these other limitations, whatever they are about to explain in this paragraph, sorry, the severity of the limitations is much higher. So like if you read the introductory line here, in case of certain subject matters, limitations of auditor's ability to detect material misstatements are particularly significant. See, in this, which means that in the case of these other limitations, the chances for auditor's opinion going wrong are much higher. So what are that other matters? See, in one of the past examination, there was a question. They asked some question like this: in case of certain subject matters, nothing but this sentence they have taken. This sentence they have given as it is in the question. In case of certain subject matters, limitations on auditor's ability to detect material misstatements are particularly significant. Explain what are those matters. This is what the question. So they have given this statement: in case of certain subject matters, limitations on auditor's ability to detect a misstatement are particularly significant. Explain what are those matters. Nothing but they are indirectly asking you to write what are those other limitations in which the significance is very higher. So indirectly they are asking what are other limitations. Just you are supposed to write the 4 points given here, 3 marks. So the difficulty lies in understanding the question, guys. That's why I always say, when you are reading the subject of audit, conceptual clarity is much important. Just by hearting the content alone will not be enough. Understanding the concept is very important. By reading the question, you should be in a position to find out which question they are asking, to which concept this question belongs to. That is the most important thing in the auditing exam. Especially my memorizing or by hearting the content is not going to help you out. So this is how the questions were tested. So now let us try to understand what are those other limitations where impact is very higher. Number one is fraud, particularly fraud committed by top level management, senior management. If they are involving in the fraud, there it is even more difficult to find than the employee committed fraud. And whenever there are existence of related party transactions, if there are related party transactions are there, then also the chances of auditor's opinion going wrong are very higher. Why? Because when it comes to related party transaction, the scope for manipulation will be much higher. And even non-compliances with laws and regulations, even auditor might not be able to find non-compliances with all the laws and regulations. So some non-compliances with the laws and regulations might not come to auditor's notice, no matter how effectively he does the audit. Along with that, if there are any events or conditions which cause entity's ability to stop as going concern, that is also very difficult to find out. So these four are other matters, other inherent limitations where the impact is much higher. What are that four other events? Number one, fraud, particularly involving senior management. Number two, existence of related party transaction. Number three, non-compliances with the laws and regulations. Number four, entity's ability to stop as a going concern. And if you observe carefully, each and every matter of other limitation will be covered in a detailed manner in the standards on auditing. So fraud regarding senior management, that will be covered in the fraud and responsibilities of auditor chapter. SA 550 will be covered in the standards on auditing. SA 250 also will be covered in the standards on auditing chapter, and SA 570 will be covered in the standards on auditing chapter. So these are the four matters where the impact of the inherent limitations is even more significant. So this is what regarding inherent limitations, four categories of inherent limitations we have seen: nature of financial reporting, nature of audit procedures, and then we have understood even time and cost benefit comparison, and then finally other limitations. Now we have one more small question. See, I told that audit is different from investigation. No, audit is not like an official investigation. So some powers might not be available for the auditor. Now in study material, there was one of the question. This is something newly added information in the study material. So I do expect this question is having high chances of getting tested in the examination. This question is having high chances of getting tested in the examination. So I will revise this also. Very simple. What are the differences between audit and investigation? They will ask you here. So if I tell you what is the difference between audit and investigation, see, investigation is a special assignment. Investigation is a special assignment. It will always be done with special purpose. Like investigation might happen for finding out the frauds. Investigation might happen only on one particular item of financial statements. Like investigation can only happen only in the area of purchases. So audit is different from investigation. Why? Because investigation is a critical examination, in-depth examination of accounts, always with a special purpose. What happens with a special purpose? Investigation always happen with a special purpose. Whereas audit assignment is a general assignment. We will not do audit only to find out frauds. Audit we do with a general objective of expressing an opinion. So it is a general assignment, but investigation is always a special assignment which will be done exclusively with the objective of finding out the frauds. And one more thing, audit will happen regularly. Whether you find a fraud, you don't find a fraud, year after year audit will happen regularly. But investigation will be happening only if required. Investigation will not happen year after year. Investigation will happen only when required. Whereas audit will happen year after year. Whether you find a misstatement, don't find a misstatement, whether you find a fraud, you don't find a fraud, all that doesn't matter. Audit will happen every year. Investigation will happen only when required. And one more point of difference, in audit we don't start with a completely negative attitude. In audit, we don't start with the notion that in this company compulsorily fraud is happened, I have to find it out. Will we start audit with this completely wrong notion? No. But investigation always starts with the wrong notion. If I am doing investigation, I will start with completely negative attitude only. In this company, there is some fraud which I have to find out. That's all. So audit will never start with completely negative notion, but investigation always starts with negative notion. And one more point of difference, if I have to say, audit is a reasonable assurance assignment, investigation is an absolute assurance assignment. Audit gives you reasonable assurance, whereas investigation will always give you what? Absolute assurance. In investigation, we try to get absolute assurance of the audit. Clear, everybody? And along with that, one more important point, most of the cases, what will happen is investigation results from prima facie findings of the auditor. Which means in most of the cases, auditor will do the audit. He will have some findings. On that findings, detailed investigation will be ordered. This is what in most of the cases will happen. So this last sentence is very important. It is quite possible that sometimes investigation results from prima facie findings of the auditor. Whatever findings of the auditor are there from the audit, those findings may call for requirement of investigation. Clear? So these are the simple differences between audit and investigation, and I do believe that there are more chances that this question might get tested in the current examination. That's what I am believing. So that's why I thought of revising this particular point also. Clear, everybody? Next one. Let us now try to proceed further with remaining concepts. Now we will discuss two important characteristics which every auditor must possess. So what are that two characteristics? Let me list them out. So the two important characteristics which every auditor must possess are, number one is professional skepticism, and number two is professional judgment. So there are two important characteristics or qualities, you can say, which every auditor must possess. Number one is professional skepticism, and the other one is professional judgment. So first I will try to revise what is this professional skepticism. Professional skepticism refers to three things. Number one, it refers to maintaining an attitude of questioning mind. Number two, it involves being alert to unusual circumstances, And number three, critical assessment of audit evidence. So professional skepticism includes the three things. It involves attitude of questioning mind, maintaining an attitude of questioning mind. You should not blindly believe anything. Whatever information that you are getting in the client, you need to have a questioning mind. So attitude of questioning mind. Number two, it involves being alerted to unusual circumstances. Whenever you come across unusual circumstances, you should not ignore it. You have to remain alert to it. And whatever audit evidences which you are gathering, to that audit evidences, you have to make a critical assessment, critical analysis of audit evidence you have to do. So this in short, I call it as ABC of professional judgment, ABC of professional skepticism, attitude of questioning mind, being alert to unusual circumstances, critical assessment of audit evidences. Now, when I am saying you have to remain alert to unusual circumstances, the standard has also given examples of unusual circumstances to which you should remain alert. So they have given examples of 3 unusual circumstances to which auditor should remain alert. Number 1, you should remain one example of unusual circumstances is conflicting audit evidences. When you find conflicts between multiple audit evidences, see, for one item of financial statement, we can get evidence from multiple sources. When all the evidences are related to single item, they should all match with each other. But what is happening is auditor got evidence from multiple sources regarding same item, but they are conflicting with each other. They are having mismatch against each other. So conflicting audit evidences is one of the example of unusual circumstance to which auditor should remain alert. And also, when you have doubts regarding reliability of audit evidence, whenever auditor comes across any circumstances of reliability of audit evidence, doubts regarding reliability of audit evidence, like you have seen some invoice, on that invoice corrections are there, so you are able to see some strike offs. So like that, whenever you come across any circumstances which bring into question the reliability of audit evidence, the trustability of audit evidence, that is also one unusual circumstance to which auditor should remain alert. Similarly, if you come across any situation of possible fraud, if you come across any situations of possible fraud, to these circumstances also you should remain alert. So 3 examples of unusual circumstances to which auditor should remain alert: when you have conflicts between multiple audit evidences, when you have doubts regarding reliability of audit evidences, and whenever you come across situations of possible fraud. And when I say you have to make critical assessment of audit evidences, that means you have to critically analyze audit evidence, whatever you have gathered. And when I say critically analyze audit evidences, you have to analyze audit evidence from multiple perspectives. Like you have to analyze, is evidence obtained is sufficient? Is evidence obtained is appropriate? Did you get the evidence from reliable sources? And is there any requirement of alternative or additional evidences? So like this, from multiple perspectives, you need to critically analyze the audit evidence. So what questions you have to ask regarding evidence? Whatever evidence that you have got, is it sufficient? Whatever evidence you have got, is it appropriate? Whatever evidences you have got, are they reliable? Whatever evidences you have got, will they be sufficient, or do you need any alternative or additional evidences? So these are 3 aspects of professional skepticism. And one more thing here, by maintaining an attitude of professional skepticism, auditor can reduce certain kind of risk. What will happen? By maintaining an attitude of professional skepticism, auditor can reduce certain kind of risk. So what kind of risk will be reduced by maintaining an attitude of professional skepticism? 3 kind of risk will be reduced. Number 1, overgeneralizing while taking decisions. By maintaining professional skepticism, the auditor can reduce the risk of overgeneralizing while taking the decisions. What do you mean by overgeneralizing? Overgeneralizing means I started with the verification of purchases. I did not find any misstatement in the financial statements. Now doing overgeneralization means I'm coming to a conclusion that since in the purchases I am not able to find misstatement, in all other areas also there will not be misstatement. This is overgeneralization. Is this overgeneralization good or bad? This is bad. But if you have a questioning mind, you will not do this overgeneralization. If you have questioning mind, you will feel that if in the purchases area there is no misstatement, there could be misstatement in other areas. So by maintaining professional skepticism, you can reduce the risk of overgeneralizing while taking decisions. Number 2, by maintaining professional skepticism, you can reduce the risk of overlooking unusual circumstances. You will reduce the risk of ignoring unusual circumstances, you will pay more attention. Similarly, by maintaining professional skepticism, you can reduce the risk of taking inappropriate decisions regarding audit procedures. That means by maintaining professional skepticism, you will take more appropriate decisions, which is indirectly told as it will reduce the risk of taking inappropriate decisions, which means you will have a chances of taking more appropriate decisions. So by maintaining professional skepticism, these 3 kinds of risk will be reduced: overgeneralizing while taking decisions, overlooking unusual circumstances, and taking inappropriate decisions regarding audit procedures. This is what simply the meaning of This is what simply the meaning of professional skepticism. Now, one more quality which every auditor must maintain is professional judgment. Professional judgment simply means whatever decisions the auditor is taking, that decision should be on the basis of knowledge, experience, and training of the auditor. Whenever auditor has to take the decisions, he should not come to a decision whatever comes to the mind. For example, he has to take a decision regarding positive opinion or negative opinion. He can't simply take a 1 rupee or 2 rupee coin and toss it and say if heads comes positive, if tails comes negative. No, your decision should not be like this. Whatever decisions which are taken by the auditor, that should be supported by auditor's knowledge, experience, and training. So the ability of the auditor to take decisions using his knowledge, experience, and training, that capability we call it as professional judgment. And auditor, whenever he has to take the decision at the beginning of the audit, at the occurrence of the audit, or at the conclusion of the audit. So throughout the audit, whenever auditor is required to take the decisions, the auditor should take all that decisions using his knowledge, experience, and the training. That quality of the auditor, we call it as professional judgment. That's all. This is what regarding professional skepticism, professional judgment. With this essay 200 related discussion we have completed. Now let us try to proceed further with remaining concepts from this particular chapter. We will try to have quick understanding regarding them. So now there is one small concept from essay 220 which says before you take a decision regarding accepting or continuing client relationship. Before you take a decision regarding accepting or continuing client relationship, what factors the auditor has to consider? Before you take a decision of accepting or continuing client relationship. But first we should know, essay 220, this concept is from. But before that, we should know when we will take a decision regarding acceptance, when we will take a decision regarding continuing of the client relationship. So like for example, if a new client is approaching and asking you to do the audit for the first time. You have no past experience working with the client has come to your office for the first time and asking you to do the audit for them. If you have to take a decision, here what decision will you take? When a new client approaches you and asks you to do the audit, will you take a decision regarding accepting or continuing? Here you have to take a decision regarding whether to accept the client relationship or not. Sometimes existing client only will approach. You know the client already very well. In the past year also you have done some audits for him. So if an existing client comes, but if he is coming with a new engagement, existing client, but what? New engagement, just a minute. When existing client is coming to you, but he is bringing a proposal for new engagement. Like last year for X Limited, I have done the company audit. In the current year, the same client X Limited is approaching me and asking me to do the tax audit. Same client only, existing client only, but he is coming with a proposal of new engagement. Last year I did company audit. In the current year, he is asking me to do tax audit. So if the existing client is there, but he is coming up with a new engagement, here also I have to take a decision regarding whether to accept or not. But existing client, if he is coming with a proposal of existing engagement, then I have to take a decision whether to continue the client relationship or not. Like last year I did the company audit for X Limited. In the current year also, the same client is coming to me and asking me to do company audit only. So existing client, existing engagement, I have to take the decision regarding continuation of client relationship. So whatever it is, before you take a decision whether to accept a client relationship or before you take a decision whether to continue the client relationship, what factors auditor will consider? And those factors are given under SA 220. Those factors are given where? In SA 220, and SA 220 will ask you to consider 4 factors before taking that decision. So what are that 4 factors? Number 1, you have to consider integrity of the management and those charged with governance. Integrity of management and those charged with governance. Nothing but whatever client which has approached you asking you for doing the audit, you need to check whether the management of that client are honest people or dishonest people. If I came to know that the management of my client are honest people only, I will try to accept the audit. If I am a risk aversive auditor and I came to know that my client's management are not honest people, they are dishonest people, I will try to stay away from that audit assignment. So first I have to check integrity of the management and those charged with governance. Number 2, I need to check if I accept or continue this audit, am I in a position to comply with ethical requirements, especially independence. I need to check what? If I accept or continue this client relationship, am I in a position to comply with ethical requirements? That I need to consider. Similarly, I need to consider, am I competent enough? Do I have enough of competence and capability? If I accept this particular client's audit, do I have enough of time and resources to complete the audit? It should not be like out of excitement I have accepted the audit. Later I realized I don't have enough of time and resources to complete the audit. Now if I stop the audit in between, my client will suffer and even I will also suffer. So that's why before accepting or continuing the audit itself, you need to decide, do you have enough of capabilities to complete the assignment which you are accepting? Similarly, even I need to keep in mind significant matters which have arisen during the course of previous audit assignments. This point is particularly suitable in the case of existing clients. If you have already done some assignments in the past, if any significant matters have arisen during the course of previous audit assignments, I will consider them also while taking decision to decide whether to accept or continue the client relationship. So these are the 4 factors which auditor should consider before accepting and continuing client relationship, and where these factors are given in essay 220, the factors are given. Clear? So now we will try to understand essay 210, agreeing to the terms of audit engagement. One important topic from this essay 210 is engagement letter or letter of engagement. So now what is this engagement letter or letter of engagement? Engagement letter or letter of engagement is nothing but a written document which is given by auditor to the client. Which is given by whom? Auditor to the client. And what will be there in this written document, sir? Nothing but all the terms and conditions of the audit will be there. So engagement letter is a written document which is given by auditor to the client regarding the terms and conditions relating to audit. So that document which contains the terms and conditions relating to audit, rights of auditor, duties of the auditor, management duties, management responsibilities, fees. So all these terms and conditions are written down in a piece of paper which will be generally prepared by auditor and given to the client. So that written document only we call it as engagement letter or letter of engagement. Sir, what is the purpose of having that written document on a piece of paper? So, simply to reduce the chances of misunderstanding between auditor and client. So, if auditor and client, if they don't write the terms and conditions in the piece of paper, what will happen is tomorrow there might be so many conflicting issues between auditor and client. Like management will come and say auditor is required to prepare financial statements. Auditor will say, no boss, that is not my responsibility, it is your responsibility. But the client is not agreeing. So these kind of issues can come up between auditor and client. In order to reduce the chances of misunderstanding between auditor and client, before you are accepting the audit, all the terms and conditions relating to the audit will be put down on a piece of paper which will be generally drafted by the auditor and given to the client. Auditor also will sign it, client also will sign it. And one copy of this engagement letter will be kept with the auditor, one copy of engagement letter will be kept with the client, so that in future if any conflicts come, they can refer that engagement letter and solve that misunderstandings. Clear? And one more question here, where engagement letter is highly recommendatory, in the case of statutory audit or in the case of non-statutory audit? Engagement letter is highly recommendatory in the case of non-statutory audit. Where it is highly recommendatory? Non-statutory audit. Why? Because in the statutory audit, even if you don't have engagement letter, law will come to your rescue. Why? Because in case of statutory audit, law will tell terms and conditions. So in the case of engagement letter, even if you don't have engagement letter, law might come to your rescue. But in the case of non-statutory audit, there is no law which is governing the audit. So in the case of non-statutory audit, the chances of misunderstanding are very higher, and in case if the misunderstanding comes, it will be highly difficult. No law will come to the rescue. So that's why engagement letter is highly recommendatory in the case of non-statutory audits. And what contents should be there in the engagement letter? Let us have a look at it. What should be the contents of the engagement letter? So if we have a look at it, yeah. So contents of engagement letter, as you could observe here, title should be there, one appropriate heading should be given, generally at the center of the page, engagement letter or letter of engagement, heading will be given, addressee will be there, addressee will be the management of the client. Then you have to include a paragraph regarding objective and scope. A paragraph should be there explaining about responsibilities of auditor, a paragraph relating to responsibilities of management, and you should identify what is the applicable financial reporting framework, and even you have to give reference to expected form and content. That is how you are going to prepare the audit report. Finally, auditor will sign it and it will be given to the client. Client also will sign it, and client, by signing the document, he is indicating that he has agreed to the terms and conditions mentioned in that engagement letter. Finally, date date and the place also will be included in that engagement letter. Clear everybody? So this is what the contents of the engagement letter are. Understood? And that engagement letter has to be prepared as per SA 210. These contents are mentioned actually in SA 210. Clear? Understood? Next one. Let us now try to proceed further with next question. So requirement of engagement letter in the case of recurring audits. First, we need to understand what is the meaning of the recurring audit. So recurring audits means, first I will tell you the meaning of recurring audit. Recurring audit means if the last year auditor is also appointed as current year auditor, that audit assignment we call it as a recurring audit. Last year auditor is only appointed as current year auditor, then we call that assignment as recurring audit. Now assume that if the last year auditor himself is getting appointed as current year's audit, last year he would have already given the engagement letter. Now the same auditor is getting appointed for the same company in the current year. Is there any requirement on the auditor to give the engagement letter once again in the current year? Like for example, for the year 1920, Mr. X was appointed as auditor of the company A Limited. For the year 1920, auditor gave engagement letter. Client also signed it. Now the same person is appointed as auditor for the year 2021 also for the same company. Now in the current year also, is he required to give the engagement letter once again? Is it mandatory? Last year he has given. Now once again same company, same auditor. So is there any requirement to give engagement letter once again in the current year? The standard does not make it mandatory. They have left it to the choice of the auditor. Standard does not make it mandatory. The standard has left it to the choice of the auditor. Boss, you decide. We don't want to interfere. Depending on the facts and circumstances, let the auditor himself decide in the case of recurring audit whether to give the engagement letter or not. But standard is not making it mandatory. It has been left it to the choice of auditor. But however, standard is giving us some circumstances where even though it is a recurring audit, it might be advisable to send a engagement letter year after year. Standard is telling us a few circumstances where even though it is a recurring audit, still in some circumstances you need to send engagement letter. In normal circumstances, you need not do it. But if you come across any of these following circumstances, then even though it is a recurring audit, you need to give engagement letter year after year. So what are that circumstances? If there is indication that last year management misunderstood the objective and scope of the audit. Last year you gave engagement letter, but management misunderstood the terms. So clarify it now by giving engagement letter once again. Or if any terms are revised, then also give engagement letter once again. Or senior management has undergone some change. Board of directors have changed and give the engagement letter once again. Or a change in ownership. Similarly, significant change in nature or size of the entity's business, or change in some laws and regulations, or change in financial reporting framework like change in Schedule 3 or accounting standards, or the change in auditors reporting requirements. If any of these circumstances happens, then even though it is a recurring audit, it is advisable to send the engagement letter year after year, even though it is a recurring audit. Clear everybody? Now, next thing, let us try to have one more small concept will be there in between. Yeah, preconditions to management. So one more thing, as I have told, in the engagement letter, there will be a paragraph called responsibilities of management. Responsibilities of management have been given other name also. We even call it as preconditions of the management. So preconditions of an audit. If they ask you the question, what are responsibilities of management? Even if they ask you the question, what are preconditions to an audit? Or even if they ask you the question, premise of an audit, everything shall be the same. So what are that management responsibilities, or what are that preconditions, or what are that premise to the audit? So what are management responsibilities, guys? Very simple. Management is responsible for preparation of financial statements. Management is, so I'm explaining, I'm revising. What are that preconditions to audit? Management responsibilities are premise to audit. Number one, management is responsible for preparation of financial statements, that too as per applicable financial reporting framework. Number two, management is responsible for implementation of internal control to prevent misstatements from the organization. Number three, the management should provide auditor. The management should give the auditor access to all the information and explanation required for the purpose of audit. The management should give access to all the books and accounts which are there in the company to the auditor. And in that books of accounts and financial statements, if the auditor needs extra clarification and explanation, it is also management responsibility to provide extra information and explanation. And even management should provide access to the employees or other staff in the organization without any restriction to the auditor. Clear? So what are management responsibilities? Prepare financial statements as per applicable financial reporting framework, design and implement internal controls, to provide auditor with access to all the books and documents, to provide additional information and explanation to the auditor, and even give access to the people in the organization without any restriction, so that auditor can go and get whatever information he wants from that respective staff of the client. Clear? So these three are functions or responsibilities of management. We can even call them as preconditions for an audit, or we can even alternatively call them as premise for an audit. No matter any of these three questions they are asking, we will write the same answer. Next, one more thing, a small concept will be there, in which they say, what if there is a limitation on scope prior to engagement acceptance? Before you accept an audit, then only if the client is coming and asking and putting the restriction on the scope of your work, what you will simply do. Prior to acceptance of the audit, before you even accept the audit, if the client is coming to you and asking you to reduce the scope, like for example, the management of the client has come to you, they told that, sir, you do the company audit for us, statutory audit you do for us, but in the statutory audit, we will not give access to sales related information. We will not give you even single invoice relating to sales. But you have to do the company audit for us. What you will do if you are in the position of the auditor? I will say simply get lost. I will not accept the audit only. Why? Because before accepting the audit only, if the client is putting the restriction on the scope of my work, why I will accept the audit here? What is the need for accepting the audit? So that's what even the standard says. If there is a limitation on scope prior to the acceptance of the audit, don't accept that audit at all. Don't even accept the audit. So why, sir, why we should not accept audit? They say the reason that, why? Because if the client is putting restriction, if you even continue the audit, you will not be in a position to obtain audit evidence. If you are not in a position to obtain audit evidence, you will not be able to obtain reasonable assurance. If you are not able to obtain reasonable assurance, ultimately you will give disclaimer of opinion only. So when you know that you are going to give disclaimer of opinion before acceptance of the audit, how it will be professional for you to accept the audit? So that's why before accepting the audit only, if the client is putting a restriction, don't accept the audit at all. It will not be professional on the auditor to accept that audit. Don't accept the audit, simply say no. Why? Because even if you accept the audit, you are ultimately going to give disclaimer of opinion. What is disclaimer of opinion? We will try to understand in a detailed manner in the chapter audit reporting. Clear? So one more last concept is there. With that, I will wind up my revision of nature, objective and scope of audit, which is changes in the terms of engagement after accepting the audit. Changes in terms after accepting the audit. That means a client approached you asking you for doing the audit. He did not put any restriction. All the terms and conditions, we have written it on a piece of paper. We have drafted engagement letter. Auditor signed it, client signed it, everything was fine. At the time of accepting the audit, no restriction. But when I actually started doing the audit, then the client approached me and asked me to change the terms. At the time of accepting audit, he did not put any restriction. But when I am actually started doing the audit, now the client is approaching me and asking me to put some restriction. He's asking me to change the terms when after accepting the audit. If at the time of accepting the audit only, if he put the restriction, I would have said no to the audit. But he did not put the restriction at the time when I'm accepting. When I actually started doing the audit, now the client is coming and putting a restriction on my scope, or he's asking for changes in the terms. Now what I am supposed to do? First, before I talk about auditor's responsibilities, let us try to understand what could be the reasons why the management will come to you and ask you for the changes in the terms. Why the need arises for the management to approach the auditor asking for changes in the terms. Why the need arises for the management? What will be the reasons for the client to make a request to the auditor asking for him to change the terms of engagement? Number one, it could be mainly because circumstances might have changed. The circumstances which are prevailing at the time of accepting the audit, the same circumstances might not be available when I am doing the audit. Like for example, at the time when I accepted the audit, there was no restriction. But after I have accepted the audit, then the GST department came and seized the go down. That's why the client is asking me, sir, at the time you accepted the audit, there was no seizing of the go down. But after you have accepted the audit, now the go down is seized. So that's why we request you to exclude that inventory verification from your scope. So like this, sometimes circumstances might change, which might make the client to come to the auditor and request for changes in the terms. Or sometimes the client might have misunderstood the original terms. That's why he might approach you now asking for a change in the terms. Or sometimes with a view to intentionally restrict the scope of the auditor. Sometimes with a view to intentionally restrict the scope of the auditor also, the client might approach you asking you for changes in the terms of engagement. So a request from the client to change the terms of engagement can happen because of any of the reasons. It could be because of change in circumstances. It could be because of misunderstanding of the terms originally agreed. It could be even because of restriction on the scope of the auditor. So these could be the reasons why the client will approach you asking for the changes. Now what auditor shall do? Let us try to understand. So whenever the client is coming to you and asking you for the changes in the terms, first thing we need to check, is there a reasonable justification for the same? First thing we need to check is what? Is there a reasonable justification for the same? So reasonable justification means, yes, there is a valid reason the client is asking the changes in the terms, because there is a valid reason. Proper justification is there why the client is asking me to change the terms. So if there is a reasonable justification, the standard has told, okay, agree to the changes. No problem, agree to the changes in the terms. But if you are agreeing to the changes in the terms, old engagement letter will not be valid. Cancel that old engagement letter, draft a new engagement letter containing that revised terms and conditions. So if there is a reasonable justification, you can agree to the changes, but old engagement letter will still no longer be valid. You have to draft a new engagement letter containing revised terms and conditions. Sir, what if there is no reasonable justification? So if there is no reasonable justification, straightforward, the standard has told, do not agree to the changes. Say to the client on the face, sir, I will not agree to the changes. Why? Because you are not giving me valid reasons. See, when you don't agree to the changes, two things can happen. Management will permit you to carry out the audit as per the original terms. When you say, sir, I will not agree to the changes, management will not try to bother you. They will let you do whatever you want. If the management is permitting you to carry out the audit as per original terms, no issue, continue the audit. But sometimes what will happen is, you do not agree to the changes, but the management will not permit you to carry out the audit as per original terms. Management is asking you to change the terms. You said no. When you said no, the management is not giving you enough of permission to carry out the audit as per original terms. You told, sir, I have to go and verify the stock. Management told no. No, sir, don't go to the warehouse and verify the stock. I asked them reasons. They gave some bullshit reasons, not at all valid. So I told, no, sir, I will not agree to your reasons. I have to go to the warehouse and verify the stock. But the client is saying, no, sir, you can't go. I have deployed some 10 people there. You can't cross them and go inside the warehouse. So there is no reasonable justification. I am not ready to agree to the changes in the terms, and the client is not permitting me to carry out the audit as per original terms. He has deployed the people to stop me from entering into the warehouse. Now what the standard says is, withdraw from the audit. Now what the stand says, withdraw from the audit, resign from the audit. You are no longer permitted to continue the audit. There is no requirement on you to continue the audit. Withdraw from the audit. Understood? So what, once again, if I do a quick revision, if there is a reasonable justification, agree. So, but draft the new terms and conditions in a new engagement letter. Number two, if there is no reasonable justification, do not agree to the terms. When you don't agree to the terms, if the management is permitting you to carry out the terms as per original audit, well and good, continue. In case if the management is not permitting you to continue the audit as per original terms, management is not permitting you to carry out audit as per original terms, then you have to withdraw from the audit. You are no longer supposed to continue the audit. You have to withdraw. So you have to be very careful. They might ask you a case scenario based MCQ, something like this. For example, assume that they have asked a question, something like this. So they're asking a question that management came to the auditor asking for changes in the terms. There is no reasonable justification for the same. This is what the statement given. Management approached the auditor asking for the changes in the terms, and there is no reasonable justification for that. What should be auditor's action? 4 options are given. Option A, do not agree to the changes. Option B, withdraw from the audit. Option C, both A and B. Option D, none of the above. What option will you choose from? Once again, I am repeating the facts of the question. They have told management approached the auditor asking for the changes in the terms, but there is no reasonable justification. What auditor should do? Option A, do not agree to the changes. Option B, withdraw from the audit. Option C, both A and B, that is do not agree and also withdraw. Option D, none of the above. Which option will you choose from? The correct option will be only option A, not option C. If you are thinking it is option C, it is a wrong. Why it is wrong? Why? Because when there is no reason, when there is no reasonable justification, we will not agree to the changes. Withdrawal will happen only when the management is not permitting me to continue the audit as per original terms. Withdrawal is not a direct to go to option. I did not say whenever there is no reasonable justification, directly resign from the audit. No. When there is no reasonable justification, first ask the management to permit, do not agree to the changes. And if the management has permitted to continue the audit, I can happily continue the audit. The withdrawal comes into picture only when the management is not permitting you to continue the audit as per original terms. Here they did not say management did not permit you to continue the audit as per original terms. Just they told what? There is no reasonable justification. So I will not agree to the changes. Withdrawal is not a direct to go to option. So correct option will be do not agree. If I change the facts, if I change the question, see, question remains the same, but options are changed. Option A, they are telling do not agree to the changes. Option B, they are telling withdraw from the audit in case if the management did not permit you to carry out the audit as per original terms. Option C, both A and B. Option D, none of the above. Now you can choose option C. Why? Because in option B, they have clearly told that withdraw from audit only if the management did not permit you to continue the audit as per original terms. Instead of saying that, if they have given only directly withdraw from the audit, you choose only option A. But in case if they have given detailed option withdraw from the audit, if the management is permitting you not to continue the audit as per original terms, then you can choose both A and B. Hope you have understood. See, this is how the scenario based questions will be tested. Not the direct MCQs which you expect. This much conceptual clarity will be required to answer the scenario based MCQs given in the examination. Clear, everybody? So this is what the question is about. Changes in the terms of audit engagement. So with this, we have done a comprehensive revision of the chapter nature, objective and scope of audit. These are the key concepts from the nature, objective and scope of audit. Hope this will help you out. Thank you guys.